In folks today after the ECB gives their approval on that Sabadell takeover from BBVA, and then Puig, of course, posting higher sales and boosting fragrance. There's a little bit of a luxury read-through in there, Anna. We'll talk about how that gets married to perhaps what we're seeing in the French stocks.
Absolutely, and you're right to remind us to keep an eye on those French stocks, because we did get time to respond to some degree to the news about Michel Barnier becoming Prime Minister yesterday. We saw banks actually moving higher on that, but they were in good company. Other bank stocks around Europe also moved higher, but we'll certainly have another day of focus on France as we wait also for that non-farm payrolls data later on today. Let's have a look at where the markets are opening up then. It's just gone 8 o'clock here in London, so we are seeing some opening trades coming through. The Stock 600 down by 0.2%. The FTSE 100 down by around that amount. We have a sluggish start for the CAC 40 and the Xetra DAX. No trades there just yet. And we did see some market response to the French news yesterday. There we go, the French market down by 0.1%. Yes, some support for the banking sector, perhaps one of the things you could point to. A little bit of spread narrowing, French debt over German debt yesterday. How long-lasting will that be? We'll certainly come to that in later conversations this hour. So for the moment, Critty, on jobs day, as we wait for the jobs report, the non-farm payrolls and the unemployment rate out of the United States later on today, we see a bit of sluggishness on European stocks. What do you see from a sector perspective?
Yeah, a little bit of a waiting issue here as well. Well, I'm going to kick it right off when we talk about the tech sector, because ASML is going to be one of your biggest weights, one of your biggest decliners that you are seeing in the index this morning. You are seeing a move of about 0.6% to the downside, right alongside Novo Nordisk, which tells you right off the bat that your healthcare sector and your tech sector are both going to be quite painful. But from a index kind of appreciation point of view, we are seeing travel and leisure outperform a little bit. The property sector as well is going to be one to keep an eye on. But banks really taking a beating, and I'm curious how much of that is a rates play, given that we're already seeing a move in the bond market this morning.
That is interesting, because some of the banks, yes, there were French ones in there, but not exclusively. Some of the banks going higher yesterday, so it seems to be a bit of a turnaround from there. There are a few banks in positive territory, but not very many. So the balance of things is tilted towards the downside. Around 3/4 of sectors do seem to be in negative territory. A bit of brightness around travel and leisure, as you point out, Critty, but it does seem to be, well, there's a bit of travel in there. There's a lot of leisure in there. Flutter Entertainment, I can see up by just over 1%.
When we talk about the movers, though, I mean, we're coming right back to the French read-through. We also see some outperformance in LVMH, and I say that with a big grain of salt, because the outperformance is coming only higher by 0.2%. That's not a massive margin of success when we're talking about those kind of moves. We are, however, and I'm going to bring this right back to some of the underperformers. This feels like a waiting story, because we're also seeing Shell underperform. You've had your eye on the miners in the commodity space this week, down about 0.7%. Novo Nordisk, Novartis, healthcare really on the back foot. Even Banco Santander, which I thought was interesting. We're seeing BBVA over in Spain as well, also taking a little bit of a beating this morning.
Yeah, it's been a tough week for commodity prices and oil prices. They've stabilised towards the end of the week, but certainly we're still around the 70 mark on WTI, 69.55 precisely, and 73.08 on Brent. Both of those up 0.5% this morning, but down on the week. Let's talk about the broader investment picture then, as we are waiting for that jobs report. One of the most eagerly awaited US payroll reports of the year out today, said at the top of the last hour. Is that overdoing it? It does feel as if there's a lot riding on this one in terms of the extent of the cuts that we get in September from the Fed. Here are a few of our guests this week with their expectations.
Look at what the claims numbers have done in the last 6 months. They would actually be suggesting that the unemployment numbers might come down for the next couple of months. The market itself is looking for a reduction in unemployment from 4.3 to 4.2.
A miss on jobs will hurt significantly, and a beat will probably be looked more favorably. What I like to look at is where are the jobs created, what's going on with manufacturing, what's going on with transportation jobs.
If I think payrolls comes in beneath 100,000, that's my threshold, because if it becomes beneath 100,000, that would be the worst of this cycle so far. So I think that would definitely add to the deterioration signs. But, you know, if our view comes right, that it's 150,000, and that's actually a bit below the consensus, which last time I checked was 165,000, then I don't think there is a risk of a repeat. I think people will actually settle down and realise that these aren't recessionary numbers.
Okay, let's get another view. Bilal Hafiz joins us, CEO and Director of Research at Macro Hive. Bilal, really nice to have you with us this Friday. Now, before we can get to the weekend, we have to get through the payrolls report, so let's do that. We were just hearing the Deutsche Bank expectations there, you know, less than 100,000, that would be bad news, but anything around the 150,000 mark, he thinks the market can live with that kind of number. What are your expectations today?
Well, great to be here, Anna. My expectation is we actually have an AI model that predicts payrolls. It's had a really good track record over the course of this year, and surprisingly, it's actually forecasting a 190 print for payrolls, so it's expecting an upside surprise. Now, of course, it won't always be right, but our model is actually leaning to the upside. So we're actually looking for, reversal of some of the moves that we're seeing today. Now, more generally, I would say that if we were to go below 160, even if it was 150 or 140, I do think the market would take that quite poorly overall.
Okay, yeah, it's interesting. So you say your model is skewing to the upside here, an upside surprise. We were hearing from Paul Dodson, our colleague in Asia earlier on, that if he looks at options markets, there's a lot of negativity around the dollar, and we already see that the yen is gaining, as if the market is maybe expecting something weak on payrolls. What do you make of that kind of positioning? Because, of course, dollar-yen, there's been a lot of focus on that since the beginning of August when we saw such a lot of movement there.
Yeah, I would say there's two things there. One is that in general, if you look at the behavior of, for example, dollar-yen around payrolls reports over the last 12 months, typically it falls a lot more on a negative surprise than it goes up on a positive surprise. So the market's aware of this skew. So that's one of the reasons why the dollar-yen is behaving as it is. The question then is the market already positioned for that? And I would be cautious around that, because when we had jolts earlier this week, you could have said the same thing, yet dollar-yen fell dramatically after that. So I would still think that even though the market's already preparing for a weak number, if we were to get a weak number, I do think we'd see an outside move to the downside.
So we can still be negatively surprised, even.
Indeed,
yeah,
yes.
Okay.
What does that trade look like if we actually do see a negative number? Is that interpreted, though, as a positive or as a negative? It's very confusing to me of whether this kind of move lower in the payrolls, which historically would be right on par, if that's actually a bad thing.
It's a good question. I would say, it depends which market you're looking at. I think if we were to see a decline in payrolls and an associated rise in unemployment rate, that would have a follow-through to the rates market. The market would then price a 50 basis point cut in September. As for equities and risk markets, I think risk markets, are very sensitive to growth dynamics rather than to interest rates right now. So if we were to see a weak number, I do think risk markets such as equities would take that badly. So rather than bad news being good news, in this case, bad news would be bad news for equities.
Let's talk about this bond market here, because you talked a little bit about how the FX market, how the dollar may be shaking out, but it really feels like it's a function of this move we're seeing, specifically in the front end of the curve, right? And this narrowing between, I'm going to say the 2s, 10s, but you can see it across the curve in terms of kind of the yield premium that's offered. In the last 5 days, we've seen a 21 basis point move in the 10-year. What is that about? Is that just repricing, or is that an overreaction, or is that a flood to safety? How would you characterize that?
It's a great question. I think it feels like it's a rerun of what we saw a month ago. If you remember before last month's payrolls, we saw a similar 20 basis point drop in the run-up to payrolls itself. And it's really back to this question of, number one, the market getting worried about a recession. So sort of globally, data over the past week has been quite poor. Could sort of indicate that. If you look at commodity prices as well. And the other one is the market is trying to work out whether the Fed will go with a 50 in September. So the market's kind of oscillating around that all. So that's a big factor within this all.
Bilal, what does your level head make of the conversation around 50? Does that feel overdone to you for September?
Personally, I think it is a bit overdone. That said, I think that if we were to see a higher unemployment rate today, I think we would go 50 in September. Broadly speaking, I think 25 makes most sense. Also, we do have an election coming up as well. And I think if you go 50 ahead of an election, you do risk getting a certain candidate in the US electoral race upset.
I mean, have you asked your AI model what it expects?
For the Fed in September?
Yes.
Yeah, we haven't quite developed the model to forecast the Fed meeting, but we will next time we speak.
We'll get to that. We've got inflation next week as well, haven't we? So you can factor that into the model's thinking. So if 50 is overdone, if we're looking at 25, I mean, do you characterise what we're seeing in the US then as just still within the realms of soft landing, almost normalisation, rather than anything more epically gloomy? Or do you want to reserve judgment until later this afternoon?
No. I mean, I'd be happy to say now, I don't think we're entering a recession, anytime soon. I do think that there is a slowing of the economy. There is a sort of slowing in the level of hiring, but there's no clear evidence that there's massive layoffs occurring in the economy, where even if you look at the Challenger job data, that's not showing big sort of job losses. What we're seeing is decline in companies being willing to hire and an increase in the workforce through undocumented workers, for example. But if you look at, say, GDP in Q2, it was very robust. If you look at personal income, personal spending is robust. None of these things are signaling a recession at the moment.
Well, let me push back on that idea, though, in terms of the kind of slowdown. You're right, the people are slowing their pace of hiring, but isn't that a point of concern itself, given that so many of the companies that were pushing the hiring spree, I'm pointing to your Apples, your Microsofts, your Amazons, et cetera, they're not replacing the workers that are quitting. You fold in the immigration story, which has also been spurring this economy. It may not be a slowdown or a recession right now, but aren't these the early signs of it? I mean, kind of what else do you need to see? Are we just waiting for that moment where we're looking at widespread layoffs? Is that the point we need to get to say, all right, well, that's a recession?
Yeah, it's a great question. And one thing in general I would say is that all the indicators that we typically look at to call a recession have all failed terribly over the last year or two. So ISM's been really weak. We didn't get a recession. Yield curve inverted. We didn't get a recession. So there's been all sorts of noise in the data. Even the unemployment rate, that it crossed the SARM rule last month, the so-called SARM rule, 0.5% move above the 12-month low. Typically, that gets triggered when you're already in a recession. And there's no evidence that we already are in a recession. So I'd be very cautious. For me, I would think that we need to see a decline in personal income, personal spending. We need to see a decline in household balance sheets values, I think, and there's no evidence that's happening. So when that starts to happen, then I think you have a much stronger case for a recession.
What does that then mean for the range that I'm bringing it right back to the bond market, for the range that the 10-year, the 2-year, if you prefer, will actually trade in? Because it feels like, although we're seeing that move lower, to your point, it could reaccelerate ahead of the U.S. election based on the inflation stats. Give us a floor and a ceiling.
Yeah, I think that in general, I would say that the dynamics of the bond market right now are that it's itching for yields to continue to go down. It just seems like the market just wants it, to sort of push lower and lower and lower. And I think the difficulty right now is if the Fed goes 50, and there of course is a chance they go 50, then the market will say, okay, they go 50, we need to start to price other 50s thereafter. So for that reason, I think you could easily see bond yields go down towards, say, 3.5, possibly even. My own view is in
the next 2 weeks?
Not necessarily in the next 2 weeks, but in the next few months or so. In the next few weeks, I think we could see another 5 to 10 basis points declines in yields. But my base case is I think that a lot of the declines have probably happened, and we'll probably see some stabilization in the next few weeks.
It seems like a lot's resting on the consumer then, if that's the case, Bilal. If the markets are focused on the growth story and all you described there. We spoke to a guest from UBS earlier on today who was talking about how actually we've seen jobs. Yes, we're seeing cracks in the labour market, but a lot of people in the US have jobs. The labour market is tight. Wages, real wages, not looking so bad. And so actually expecting some sort of stabilisation on the consumer front. How would you describe the consumer at this point?
Yeah, I would say that the consumer is actually doing relatively well. So if you looked at the Q2 data, consumer month-on-month, consumer spending was picking up, and the July data also showed it sort of picking up. So just as CapEx is coming off in the US, you're seeing consumer spending picking up. So sort of the growth pattern has been passed on from corporates to the consumer. And I think that's an important trend that we'll probably continue to see in the next few months.
Yeah, on that subject of CapEx then, that takes us to AI. And, that there's much hope attached to AI in many parts of the market at this point, it would seem. So if CapEx is coming off, does that tell us something worrying about AI and the prospects for AI?
I think it does. I think what this tells us is that the narrative of this AI mania is probably, we're probably past the peak of that, mania. I think last year was the hype, This year's about the reality. How can you use AI? And every company is discovering it's really hard to find true use cases beyond nice little demos. And we're finding at Macro Hive, we're using a lot of AI stuff. It's a real grind to kind of find out the real nuggets where it works really, really well. It takes a lot of effort to do that. And I think every company is finding that. And so I think this is a point of realism. And so as a result, I think there'll be a sort of less aggressive sort of push into AI by multiple companies.
Yeah, that's a really interesting observation, isn't it? And it chimes with what we heard from various analysts on Monday that, sank the Nvidia share price 9%, that we need to see this spreading to other parts of the economy. I think it's also interesting that there are some areas that no doubt there is opportunity in AI, like pharma and drug discovery. Yeah. But when we spoke to Sandoz, I think it was earlier this week, they were saying, well, actually, we use a lot of AI already. So that's another reason to be perhaps a little more cautious about AI expectations.
And there's always the question of monetization, to your point. There's so much CapEx investment at your own firm as well, as you point out. And then they were waiting for to come back. But I'm wondering if we're waiting for that return on investment, does that catch up to a lot of these companies that might be running out of cash, might be running out of the stimulus, might be running out of the extra issuance that they've been sitting on? At what point do you start to see a liquidity crunch from corporates themselves at a time when we're already seeing the consumer less willing to digest price hikes?
Yeah, absolutely. I think this is going to be a particularly challenging time for corporates, over the next few months. If you look at overall valuations of stocks, they're expecting quite strong earnings growth in the next 12 months. And so to realize those earnings, it's going to be very, very hard. So I think there will be a pullback. There will be many companies starting to scale back or go down, unable to raise the requisite capital to fund that all. The one kind of interesting dimension to this is the larger big tech companies, they're all reiterating that they don't care about profitability. They're going to invest massively in AI and so on. So whether it's Microsoft, Apple, and Amazon, the twist with this one is that normally these companies are independent of each other. They aren't really direct competitors. This is probably the first time in multiple decades that they're going head to head. So it's a zero-sum game now. Yeah. One gains, someone else loses. So that's another factor that could see profit margins challenged. So all of this is kind of giving quite a gloomy outlook for the corporate sector.
Well, the luxury that they have and the names that you're talking about is they're sitting on trillions and trillions of cash they can't deploy in terms of acquisitions or buybacks or whatever that may be. So AI feels like the only correct alternative. Bilal Hafeez, we have to leave it there. Fascinating conversation. CEO and Director of Research over at Macro Hive. We talked a lot about the macro. Let's talk about some of the other heavyweights, specifically in this part of the world. Get a quick check on the core 6, because we are seeing a little bit of pressure there. When you look at ASML, down about 0.6%, and on Schneider Electric, also down 0.7%. My eye goes straight there simply because we're talking about that weakness in the tech space, but we're also seeing it in the pharma space as well. Novo Nordisk, a whopping 1.3% decline there as well. Gains, however, in Ferrari, higher by 0.3%. Luxury names, whether it's LVMH, whether it's Puig, seem to be doing quite well today. LVMH, I should say, by comparison, though, it is down 0.4%, but significantly less down than some of its other heavyweights as well. Significantly less down than the rest of the markets. There's got to be a better way to say that. But the point is, Ferrari is in the green.
When you say things and in your head they make perfect sense.
But it all made sense in my head.
I'm sure it did. Pretty with some new language around the markets. Let's get a check on the markets and some individual stocks on the move. Lizzie Burden has a rundown. Lizzie.
Well, I'll try and get my words out, Ada. It's generally a risk-off session across Europe, and for France, it's a risk-off as well. We have had the political gymnastics out of Paris, Michel Barnier as the new Prime Minister, but there's still lots of uncertainty around this. We don't know what sort of compromises he's going to be willing to make with the far right, for example. We haven't heard much out of him since Brexit. So just focusing in on some of these French stocks, all of these banks in the red this morning. But if we turn to the chip stocks as well, they are in negative territory, lots of them, because of the read-through from the Broadcom results last night. This is, of course, the chip supplier to Apple. It fell in late trading after a disappointing sales forecast, and indeed we are seeing a read-through to ASML, ST Micro and Infineon this morning. Just flipping over to the earnings picture, we haven't got Puig trading yet, but Barclay is, and it's in the red. It was up earlier, so fluctuating somewhat, but real estate had been one of the the few sectors on the Stock 600 to be eking out gains this morning, leading the gains the last time I checked. And it was a stable set of results from Barclays, actually. They said that their full-year pre-tax profit forecast met estimates. And, of course, we've also had Barra and Vistry reporting earlier in the week. Barclays a little different. It's at the pricier end of the spectrum. And, of course, we've got a new Labour government that's really prioritising home building. It's overhauling the planning system. And, actually, Barclays could get hit by the crackdown on non-doms in that October 30th budget. So we keep an eye on that. We also have the macro influence on the home builders this morning. We had the Halifax data saying house prices rose slightly in August thanks to the Bank of England's rate cut, but we will keep an eye on those again throughout the session. And just finally, I've thrown in Darktrace because they had some corporate news this morning. This is, of course, the cybersecurity firm. It's being acquired by private equity firm Thoma Bravo, and it's named Jill Popelka as its new CEO, replacing Poppy Gustafsson. But traders kind of welcomed it earlier. Now Darktrace in the red.
Thanks very much, Lizzie. Lizzie Burden with details on some of those stocks on the move. Coming up on the programme, we'll get back to that chip story. Critty was just talking through some of the moves on ASML. We've had some new lines coming out at the Dutch. We will get to those shortly. Lizzie was talking about how the sector is responding. The US has slamming China with new export curbs on advanced technologies. This is quantum computing and the like. Find out exactly what they're targeting now in our next conversation. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Welcome back to the opening trade. About 22 minutes into the session, and right now we're going to dive right into the chip story because we are seeing ASML and some of the other chip sector stocks take a little bit more of a beating. Remember, the market is down as altogether, but ASML is one of the biggest weights, down by 0.8%. This, of course, comes off the heels of news that the United States is going to be widening what actually is included in those chip exports, and it now looks like you're getting not only Taiwan following the U.S.'s lead, but the Dutch as well. Let's get more insight on this. Bloomberg Daybreak Europe anchor Tom McKenzie joins us now. Tom, let's just simply start with, what do these export controls actually include?
Yeah, and look, it's a reminder that almost on a weekly basis, there's this drip of additional restrictions, or at least planned restrictions from the US and in some cases its allies as well. So the latest line is a focus on quantum computing and as well equipment in the high-end semiconductor space. And that builds on the restrictions put in place in October of 2022 by the US. These are export controls. They are worldwide. They are global, so they are not particularly targeting and specifically targeting China, but of course China will be front and center in terms of the thinking around this. And the only countries that get exceptions are allies like Japan, like the Netherlands, like the UK as well, who have already, the UK back in April, put in place similar export controls around similar levels of technology. So the US saying, actually, we're playing catch up on this front to some of our allies in terms of the export controls around quantum computing. The US and China neck and neck in terms of building out these computers that some expect maybe in the next decade could prove remarkably consequential in terms of rewiring the global computing system, and particularly consequential for the world's militaries.
And you mentioned the UK and what it's been doing ahead of this US move. We heard from the Dutch just this morning, the Dutch saying they're aligning their export controls with the US on some ASML machines. So it seems, I don't know how much quantum computing link there is there, but at least the politics seems to be holding strong with the exemptions that you mentioned. There's other chip news as well. Intel said to explore the sale of part of its stake in Mobileye. We seem to get week after week lots of stories about what Intel does next. How does this fit in?
Intel, the stock down 60%, losses in the last quarter of around $1.5 billion US. This is a company facing the biggest crisis in its 56-year history. So absolutely, to your point, we're getting these leaks and details about how Intel may be thinking about restructuring its business and raising funds at this crucial point. So the latest lines, Reuters reporting they have an 88% stake in this US-listed Israeli company, Mobileye. They've already sold down some of it earlier this year. They're considering selling down again, but this is a stock as well that is down around 70% year to date. So how much
and
they can...
to the auto sector.
And linked to the auto sector, which, as we know, faces its own challenges. It's a company that makes software and hardware around autonomous driving. It's facing its own challenges. So how much value they can extract from that is questionable, but it really points to, if not desperation, then the urgency being felt across Intel. Other lines crossing as well, reporting that Qualcomm is looking at eyeing up some of Intel's assets. We know that they're considering, Bloomberg reports, they're considering spinning off even potentially its enterprise business, potentially even its foundry business. Citi, by the way, putting out a note saying that even if they succeed in building out their own foundries, they put that likelihood of success as being minimal, according to Citi.
A lot going on in the chip space. You've got the geopolitics, you've got the restructurings. I mean, to think that Intel and Qualcomm used to be the heart of the global chip industry and in the States, and to lose all that market share globally is a fascinating one. Bloomberg Daybreak Europe anchor Tom McKenzie all over that story for us. Let's talk a little bit about some of the other parts of the market that are trading lower. And of course, that is going to be putting the French stocks very much in focus. Coming up, we're going to talk about the drivers behind those market moves. The new French premier inheriting a hung parliament and a very fragile economy. We're going to discuss the market's response with Edmond de Rothschild, Marie Jacot next, what she thinks about the read-through of the appointment of Michel Barnier and what that actually means for something like the budget. That conversation next. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
I think that the choice of Michel Barnier is a very good one. I know Michel Barnier. I think it's a man who inspired confidence, and including, of course, in Europe, where he was so instrumental.
In the Brexit
negotiation. But difficulties are enormous, including political, but also not only political, also in terms of finance, financial problems and fiscal problems.
Well, he's a fan. Former ECB president and governor of the Bank of France, Jean-Claude Trichet, of course, speaking exclusively to Bloomberg over in Asia overnight, giving us early reaction to the news around the new prime minister. So, new prime minister Michel Barnier has just weeks to deliver a budget which can withstand a fractured parliament, if that is possible. Speaking just yesterday, he made a plea for unity.
We will act more than talk. We'll try to find solutions coming from everywhere. The government will not pretend to have a superior knowledge. I have learned in my long public life that good ideas come from everywhere, often from the bottom, the most humble of people, when you take the time to listen to them.
So a plea for unity there. Marie Jacot joins us, CEO of Edmond de Rothschild Asset Management France. Marie, excellent that you're able to join us this morning, because there's a lot to talk about when it comes to the French story. You know, Jean-Claude Trichet, clearly a fan of Michel Barnier. He's a very well-known quantity. He's a man with huge experience in France. Many people outside France, certainly here in the UK, feel like they know him very well. We saw a bit of market reaction to his appointment, a little narrowing in spreads if you really look hard for it, but not much. It's going to take more than his appointment, it seems, to narrow spreads against German bonds.
There's been a good reaction so far, but we believe that it's likely that volatility will remain in the market. I think what's the good news is that after considering several candidates like Xavier Bertrand, Bertrand Cazeneuve, Thierry Baudet, President Macron has chosen a prime minister who's part of the Republican Party and who is, in theory, not threatened by a censor by the Rassemblement National. But that's a tacit support and leads to a quite fragile political situation in terms of his ability to pass reforms and budget.
I've seen some people comment that perhaps it is Marine Le Pen who will feel a little emboldened by the appointment of Barnier, and you saw Barnier mention immigration and security and things that maybe would appeal to the further right in France. Is that your interpretation, and where does that leave the left and its willingness to cooperate?
It's going to be a subtle game in Parliament. I think, if we take the example of the pension reform, for example, the advantage of that government is that it is in line with the outgoing government, so the likelihood that they are going to try to reverse decisions by President Macron is relatively low. Having said that, the repeal bill by the La France Insoumise could get traction, and it's also possible that the Rassemblement National and Marine Le Pen decide to increase or position their stance as an opposition party and support it. They could, also want to send a message that their tacit support is not an active one and an explicit one, and also show that they're calling the shot in Parliament. So there is a risk of, potentially costly measures to, not be completely avoided.
Put that into some context for us. You mentioned the budget there and the pension reform, of course, bleeding into the budget in terms of the costs, which got Macron into trouble in the first place when this became an issue. We all remember the protests that were hitting Paris and other parts of the country as well. The numbers around the deficit seem to be like a very wide range when you look at it from I think both believe 5.6% deficit on 2024. We're trying to shoot for, I think Bruno Le Maire at one point promised something close to 5%. We're not getting there anytime soon, no matter who you ask, the IMF, the French government themselves. What do we need to see for that budget to be more digestible for the EU?
So first of all, as you said earlier, they're going to have barely 2 weeks to come up with measures. And the issue is that, fiscal policies and decisions have clearly not been at the heart of President Macron's consultations in the recent past. So the government is really going to have to work under huge time pressure. And we know because of Michel Barnier being from the Republican Party that they're in theory going to avoid increasing revenues through increasing taxes, but we don't know that for sure, and it's at this point of time very difficult to say what sort of measures they are going to come up with. But one thing is sure is that it's the absolute priority for this government, and they have very little time to implement. So what it means is that he's going to be able to get anything done. He's going to have to, at the bare minimum, get the abstention from some of the non-affiliated deputies or LIOT, for example, if not the active support from some of the extreme right deputies in Parliament. Otherwise, he's going to have to use the 49.3 over and over again, and then he risks a vote of no confidence, and then, nothing is going to get done, really.
So it all seems like a very scary and a very kind of frustrating and intense situation that doesn't necessarily yield positive results given the time crunch. But on the positive side, if I may inject some happiness here, is that Michel Barnier is a skilled diplomat. He is a skilled negotiator. So I think the logic from some has been that he can actually manage the division that you're seeing in Parliament. The other side of it is that from the EU side, there may actually be concessions to the French government if this deficit doesn't quite match their standards. Does that change your view on France and the investability of France, given the cushion that they may get from the EU and given the global confidence that perhaps is growing in this pick?
That would certainly be helpful. And when you look at how the markets have reacted so far, and French equities, for example, you see that the French stocks that were purely domestic ones have actually already recovered from the losses from the snap election time. And we have to remember that 85% of the MSCI France and the CAC is actually, driven by stocks that are, global stocks and have a global exposure. So I think that's, their volatility and the way they behave is actually quite independent from French politics. our position at the moment is that we've taken profits from European equities and we're neutral. We're more interested in emerging markets in the equity space, but also in the credit space, and that's really because of the recent announcement of the easing policy by the Fed, and we believe that it will help get flows into emerging markets who have actually weathered the inflation crisis pretty well. So we're quite excited about that part and that region, if I may say, of equities.
So
Europe.
So your interest is elsewhere, and is that because you think that there are risks that we just do all this again in a year? We go into further parliamentary elections in a year or so, Marie. Is that one of the reasons why you look elsewhere? Because we could see volatility or even negativity attached to politics in Europe.
It's one of the reasons, definitely. And if we go from vote of no confidence that the government doesn't survive, then it's very likely that it will happen. But I think the other argument is independent of this, and it's really linked to the worries around European growth. And more generally, when you look at growth in developed markets, recent year and then expected for the years to come, it's more around 1.6, 1.8%. Whether you look at emerging markets, you're around 4%. So the risk of recession is also lower in emerging markets than developed markets at the moment.
I want to bring it right back to kind of the French politics here in terms of how, maybe not the Barnier pick, but how Macron moves forward in terms of other policy decisions that are more oriented to things like the risk in China when it comes to EV, when it comes to fiscal spend in manufacturing, or even in services where right now French credit, to your point, is being compared to the likes of Spain and Italy and underperforming the periphery, which I'm sure a lot of French people aren't super thrilled about. But walk us through the reaction, not just to some of the other global pressures in China, but also in the United States. Macron has been very vocal about something like the IRA, for example, disincentivizing investment in France. Does this change, does the developments in France change their outlook to the rest of the world?
I don't, long term, I don't believe so. I think there was, some of the reaction was short-term reaction. I think there is a true interest in globalization, global interest, global investments that hasn't changed. And I don't think we can afford to change it, quite frankly. And certainly when we look at investors in France, in Europe in general, they have that, global view and outreach. And I don't believe that it is going to change anytime soon. I think you mentioned the French credit, and it's absolutely true. I think global markets have actually decoupled from French risks, which makes them actually not as attractive as they used to be for the time being. But with time, we believe that although we're going to have volatility for an amount of time, things are going to get in place.
But we know that Michel Barnier has a lot of experience dealing with Brussels, operating in Brussels, and we've already talked about how that might help in the sense of the French budget and maybe getting some favourable treatment there, or at least a willing ear to listen. What does this tell us about the role of France in Europe? Because Germany's busy being distracted by domestic politics as well, and so with the two heavyweights of Europe both distracted by domestic politics, I mean, does this give more power perhaps to France within Europe? The fact that they've appointed somebody with such strong European Brussels credentials to the role of Prime Minister.
Hopefully, we'll see. But it's, the Michel Barnier's profile and curriculum, surely, he's a convinced European. And in the recent context, it's obviously a very good news for Europe and Germany, I would say. And we can only hope that it's going to create a better momentum in general for Europe, not necessarily for France's role in Europe, but we certainly believe that both France and Germany have to be strong for the European project to work, not only France.
Okay, Marie, thank you so much for joining us. Really nice to see you this morning. Marie Jacot, CEO of Edmond de Rothschild Asset Management France, bringing to a close a week where day after day we were waiting for news around the French Prime Minister, and finally that came yesterday. Markets have responded for the moment, at least. Coming up on the programme, we'll talk US politics. Donald Trump unveils his economic agenda, including a role for Elon Musk. All the details next. This is Bloomberg.
in recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
I am promising low taxes, low regulations, low energy costs, low interest rates, secure borders, low crime, and surging incomes for citizens of every race, religion, color, and creed.
Donald Trump pitching his economic agenda to Wall Street and corporate leaders in New York. I want to dive right into the details here. There's so much to unpack. Bloomberg senior writer Stephanie Baker, who of course keeps an eye on U.S. politics, joins us around the table this morning. Stephanie, this one's a fascinating one for me because the economy did so well under President Trump. He represents a right-wing, I shouldn't say right-wing, but like a right-leaning party. Of course, the Republicans. The markets do better historically under Republican leadership as well. They're more market-friendly policies. This time around, there's a lot of hesitation about whether or not a Trump 2.0 would be friendly to the markets, to the business community, to the economy. What do you make of that?
Well, my big takeaway from his speech last night, and I think people aren't focusing on it enough, is his proposals to impose these sweeping tariffs, which it's part of what I think is his incoherent economic agenda. He's proposing to do all these things that don't make sense when you put it all together. Most economists, mainstream economists, will say that if you impose these sweeping tariffs on all foreign goods, 10 to 20%, as he's proposed, would cause inflation. And that goes against what he's saying he's going to do, which is, lower costs for consumers, keep interest rates low. And it risks setting off a global trade war. I don't think people are appreciating how big of a deal it is. The other thing is a lot of his proposals are not costed. He wants to extend the 2017 tax cuts at a cost of something like $4.6 trillion. Various other proposals that he has not spelled out how he's going to pay for them. It sounds great, right? We all want lower gas prices. We want lower taxes. But how are you going to pay for it? And I think that is perhaps spooking the markets.
Stephanie, what do you get a sense that American voters will be voting on? Because we, of course, talk about the policies and the economics, and we try and, get to the nuts and bolts of market expectations. I was looking at Nomura's expectations that, under Trump, inflation goes higher, the deficit higher, but also maybe GDP higher. Do voters think about that stuff when they go to the polls, or are they thinking about, they've experience of Trump already to reflect on. What sense do you get as to what they'll be voting on early November?
Obviously, pocketbook issues, the cost, inflation, costs have risen so much since the pandemic. And voters are blaming Biden for that, even though he has managed to bring inflation down. He's managed that soft landing, in a way that no one thought was possible. Brought inflation down more quickly than in Europe. The economy is growing stronger. Biden hasn't gotten credit for that. Everyone remembers the pre-COVID times with Trump when prices were lower. And I think the challenge here is that Trump is still more trusted on the economy than Kamala Harris is. What she has to do and what she's trying to do is present him as, just cutting taxes for wealthy people, and that she is the candidate that's going to really deliver for the middle class and help with, real life issues like childcare costs. And that was one of the things that he said last night that was completely incoherent, rambling answer on childcare, made no sense.
And he did spend quite a bit of time, Chrissy, talking about Kamala Harris and what she has to offer.
He did. In fact, we should just go to that sound right now in terms of the criticisms, how he and a lot of his following is interpreting her policies. Take a listen.
She's promising communist price controls, wealth confiscation, energy annihilation, reparations, the largest tax increase ever imposed, and mass amnesty and citizenship for tens of millions of migrants who will consume trillions of dollars in federal benefits and destroy Social Security and Medicare. They will be destroyed.
So some strong words there coming from President Trump, unsurprisingly, on the vague idea of Kamala Harris's economic agenda. But he's not alone in this. Economists have also said that the price gouging that she's trying to address could hurt the economy as well. So she's not clear from this, especially because we have the example of the 70s, where I think Nixon tried to do this and actually ended up backfiring on him. Do either one of these candidates actually have a plan that's going to help the U.S. economy, or are we only talking risks here?
Well, he made a number of misleading statements and outright falsehoods there. I mean, he's accused her of supporting the banning of fracking, for instance, in Pennsylvania, which she has said that she no longer supports. She did support that in 2019. It's true that Harris's economic agenda is still quite vague, but so is Trump's. Some of the tax proposals that he proposed yesterday, including lower corporate taxes for manufacturers if they produce in the U.S. It's unclear what that means. What is the definition of made in America? So I think Harris will be under pressure to outline more details of her economic vision. That price gouging proposal is quite vague. How is it really going to work in practice? And I think she'll be under the gun at the debate on Tuesday to really articulate more details on that and what her vision is. Obviously, the difference between the two is she's raising taxes, albeit less than what Biden had proposed, and he's proposing to cut taxes, but the gap of how he's going to pay for it is huge.
The Made in America piece that you bring up is one that Anna's been pointing all morning to, which is that the thing that is Made in America brand, is it assembled in the U.S. or is it?
I mean, define it how you will. I'm not sure if that detail is available to us yet.
But this is an issue that comes in terms of GDP counting as well from the economic bureaus as well.
Yes, right. So that's the politics. And Stephanie, thank you very much for the update there, Bloomberg. Stephanie Baker with that. So what does this mean for markets if we were to see a Trump 2.0? Bloomberg EMEA FX and Rates Managing Editor Rachel Evans with us has been thinking about this, of course, from a market's perspective. Give us an update on Trump's latest stance on the dollar and how his stance on the dollar fits with what he's trying to do on tariffs.
Yeah, it's all a little bit disjointed. But I mean, he's come out through the course of the campaign and talked about wanting to favour a weaker dollar, sort of discarding the strong dollar policy that sort of marked kind of the administrations of the last sort of 20 years or so, to kind of try and sort of make America more competitive in that respect by having a sort of weaker currency. The tricky bit with that is that some of his other policies that he's outlined would, all else equal, boost the dollar. So we're thinking about, if you do have, for example, corporate tax being lowered to 15%, as he's been talking about most recently, that, obviously isn't necessarily something that is going to be good from a income perspective for the US government. You are likely to see the deficit rising as a result of lower tax, and that should, all else equal, keep the dollar stronger. You might see kind of the Federal Reserve being able to cut less aggressively, something that would weaken the dollar, because they need to kind of basically keep rates high to cut down on some of the inflationary pressures that policies like tariffs would potentially encourage. And then when you look at tariffs themselves, you know, if you're hitting China or Mexico, again, those are things that are likely to kind of keep the dollar strong.
Yeah.
So some of this is a little bit
You're right to keep pointing us back to all else being equal, Rachel, because, you know, we do our best to draw conclusions about Trump's past presidency, but then COVID happened.
Yeah.
You know, nobody saw that coming, and that then led into Biden and what we saw around inflation there. So, yeah, we can't include those things because they are unforeseeable, but we do our best in the meantime.
Not to mention the fiscal spend that has come since from the Biden administration. But Rachel, I want to come back to you in terms of, you talk about this kind of bullish dollar narrative. We were just talking to Paul Dobson in the last hour, who was talking about how positioning right now is very weak dollar. And how does that square? Is that just setting us up for a massive dislocation in the last quarter of the year?
Potentially, yeah. I mean, I think obviously in the last sort of 2 months or so, we've started to see a much weaker dollar as everybody kind of gets ready for Fed cuts. And we did see sort of positioning amongst hedge funds and other speculative traders flipping from being sort of bullish to being bearish the dollar. It makes sense. You know, the macro sort of backdrop is very much leaning towards those kind of aggressive Fed cuts. So that's ultimately what really is kind of driving markets at the moment. The politics is kind of a cross current that creates a bit of noise from time to time. But yeah, if we do see kind of, you know, a Trump presidency coming in, that could potentially prompt a lot of a rethink about the path of the Fed and the path of the dollar.
So that's the politics. We wait for November to get clarity on that. In the meantime, we're waiting for a jobs report, Rachel. We've got US futures pointing downwards, increasingly, actually. NASDAQ futures down by just over 1% now. I know your focus is on other assets, but this risk aversion into the jobs report, often on days like this, we talk about people sitting on their hands until we see the data. Is this unusual?
I think people are taking a little bit of money, maybe out of the markets until they see some clarity. There is a lot riding on this print. You know, we talk about like the Fed being about to cut. That's obviously the bigger picture view, but we're really talking about how aggressively they cut. And the bond market in particular is quite torn on whether we're going to see, you know, your standard 25 basis point cut in September, or whether we could see that jumbo 50 basis points to kick things off. That would be very unusual and would sort of suggest that the Fed really does kind of see the economy deteriorating quite rapidly. At the moment, the market is pricing sort of about 30% chance of that 50 basis point cut in September, and then about 110 basis points through the end of the year. So that's just at least 150 basis point cut. So people are looking to this jobs report to really kind of decide whether it is going to be 50 or 25.
Okay, and that seems more important than CPI next week now, doesn't it, given what we recently heard from the Fed at Jackson Hole. Rachel Evans, thank you, Bloomberg's Rachel Evans. So a lot riding today, Critty, on this jobs report.
152,000 is the whisper number. 162,000 is the survey number. We'll see what happens. We might be more excited today about the jobs report. I bet you on Monday it'll be all about the CPI. That does it for the opening trade. The Pulse is up next. An all-star lineup. Stick with us. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, The moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
DOJ or other authorities
could face bigger challenges.
Fed was going to keep rate World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The dollar weakens and US futures slip as traders stand by for what could be the most consequential US jobs report of the year. The Fed's Daily and Goolsbee say lower rates are coming as the labour market cools. Emmanuel Macron picks Michel Barnier as France's new Prime Minister, entrusting the EU's former Brexit negotiator to end the political turmoil of the past 2 months. Plus, Donald Trump vows to cut America's corporate tax rate and slash regulations, saying Tesla CEO Elon Musk has agreed to lead a review of federal spending. Let's check in on these markets then. It is jobs, jobs, jobs. It's all about the build-up to the non-farm payroll print out of the US, of course, with expectations that you could get a number around 160,000 for the most recent month, the month of August. So up from July, but of course a focus as well on the unemployment rate, currently at 4.3%. Will that move to 4.2%? More importantly, what will the jobs data tell us about the depth of the cuts and the extent of the cuts coming from the Federal Reserve with that meeting September the 18th. The downside coming through for European equities. You are set to see the worst week as things stand across European stocks since the beginning of August. So the full week, you're going to see some downside, depending, of course, on how things shape up today. You've seen so far 4 straight days of losses, and we're on track for a 5th straight day across European stocks so far. Nasdaq futures also deeply in the red right now, down a full percentage point, currently pointing low by around 190 points at 18,774. We keep an eye, of course, on the ramifications of further restrictions around the tech space. The US 2-year, sensitive potentially around the non-farm payrolls, break 370 right now. More money moving into treasuries at the front end, yields down 3 basis points. You've already in this week seen yields down 20 basis points on the 2-year just in this week alone. The Bloomberg Dollar Index, important given the softness that's coming through for the dollar right now. You're seeing strength, for example, in the Japanese yen, consequential again in terms of expectations for markets beyond the US on softer dollar. Brent, $73 a barrel, currently up around 0.6%, but down for the week about 8%, one of the worst weeks since the start of the year around concerns about demand and supply. We check in on Broadcom right now in terms of the market moves pre-market on the back of their earnings that came through. And look at that drop, down 7.7%. The AI part of the business not doing too badly, but it's the legacy part of the Broadcom sales picture that seems to be weighing on concerns for that business going forward. And you can see that it's set for a bruising session. The sales forecast not meeting the expectations of the analysts out there. So let's get the show started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London. Happy Friday, everyone. Now, the dollar weakened. US stock futures slipped, as I mentioned, as traders prepare then for the US jobs data that may determine the size of a Fed interest rate cut this month, September the 18th. It's in your diaries. We're going to be speaking to Vasiliki Pachaturidi from BlackRock International about that story, get the market analysis in just the next couple of minutes. But to set things up, let's bring in Bloomberg's Paul Dobson for the MLI view on how markets are adjusting and the sensitivity around this non-farm payroll print, arguably the most important of the year. Paul, how are markets pricing for this data drop from the US?
Yeah, well, I would have said to you, if you'd asked me a couple of hours ago, Tom, that the market was very much skewed towards the risk of a negative number. If you were looking in FX markets, you'd see that the measures of implied volatility are elevated and they're pointing towards the risk that the dollar will continue to sink. That said, we've seen a pretty big move in the last couple of hours in the markets already in that direction. The dollar coming under pressure right across the board, particularly against the yen, where one of the key pressure points is. So that moderates things just that little bit, but it does seem that the market is preparing for the risk that it's going to be another negative number, another disappointment, one that not only points to the idea that the Fed is going to cut interest rates by 50 basis points to start things off, and that's going to weigh on yields and the dollar, but also that it's going to paint a negative picture for the US economy and damp that demand for equities too.
Okay, I was going to follow on that, Paul, because I'm wondering whether we have clarity as to whether or not a jumbo cut, 50 basis points from the Fed, would be positive for equity markets. In the context you've laid out for us, softer dollar, lower yields, a 50 basis point cut, if that's what we get, if that's what the data sets us up for, talk to us about why you think that may be a drag on equities.
Yeah, and I think it would be. I think that what matters is the kind of projection that we get from the Fed about the state of the economy, the confidence that they're doing. If they're cutting by 25 basis points from a position of comfort, if they're saying, we think that policy is restrictive, we think that we can begin to cut at our ease in order to sort of, lighten up a little bit that pressure because inflation is under control, but the economy is holding up, then the market can take confidence from that. It can think, okay, then equities can continue to rally. If the Fed is thinking, oh, hang on a second, this is starting to look bad, and remember, they've told us they don't want to see any more of a depreciation or a degradation in the outlook for the labor market in particular. If they cut by 50 basis points, that sends quite a different message. That tells you they're worried about the economy, and the market might start to think, hang on a second, what do they know that we don't know? Maybe we don't want to be holding equities anymore. And so I think that messaging from the Fed is actually going to be something that the market will feed off, and that's why, even though on the face of it maybe a deeper cut would be more supportive for markets, actually the impacts might be initially at least a knee-jerk reaction to sell stocks rather than buy.
Bloomberg's Paul Dobson setting us up for the data out later from the US, of course. In terms of the non-farm payrolls and the potential market reaction, Paul, thank you. Let's get more analysis right now. Bring in Vasiliki Pachaturidi, head of EMEA iShares fixed income strategy at BlackRock. Vasiliki, let's start there then. Do you agree with the analysis of Paul Dobson? What would make a Goldilocks number from this non-farm payrolls print?
Well, good morning, Tom. Well, it really feels like a back-to-school day for macro today. As you said, this is the most highly anticipated US jobs report. I do agree it's going to give us more indication about whether the Fed is going to cut 25 or 50, but let's get down to the numbers. I think the market is expecting about 165,000 print. I would say if we get anything south of that, let's say under 100K or 75,000, that could prompt a 50 basis point cut. But this is not our base case scenario. I would say anything between 114, the previous print, and 165, that would be the Goldilocks scenario that you asked me about. And I would say that would further cement that rate cuts are coming, starting with a 25 basis point cut. But even if we get something slightly above that, I don't think it would change much. It wouldn't certainly change our base case scenario, which is that the US labor market is cooling but not collapsing.
Does that suggest then that your outlier view on sub 100,000 would be what leads to 50 basis points? Would that also crystallize in your mind that maybe your views on this US economy and the US labor market are misplaced? Would that get you to reassess your otherwise relatively benign view on this US labor market? Would that push you into a hard landing take on this US economy?
I don't think so. And you know, we've been through that hard landing, soft landing, now back to hard landing scenario this year already. I think the market is pricing too many cuts right now. If you see at the U.S. Yield curve, they're pricing something like 100 basis points until year-end, 200 basis points until next year. We are more hawkish than that.
So they're pricing in too much because the economy is actually holding up better than the markets expect.
Exactly. I mean, inflation is, if you look at the big picture, if inflation is falling, growth is holding up, rates cut are coming. I think this is a very supportive environment for bonds. I mean, if we take a step back, I mean, we're entering a gradual easing cycle, and for bond lovers like me, this is a good place to be. I mean, bonds, quality bonds should do well. We have diversification. The carry trade is live. I mean, we saw investors piling in $100 billion into bond ETFs just in the last 2 months.
Yeah, has that flow got further to go? And does the bond rally around treasuries, around sovereign debt, does that have further to run, given the moves that we've seen already this week?
I think it's all about kind of the role that bonds can play in portfolios right now. There is certainly more room for the carry trade. You can get quality yield from fixed income without taking too much risk, but you can also look for opportunities to add alpha and performance in your portfolio. And we talked about the US market. I would say over there, we think that the belly of the curve in particular is better placed right now. I mean, we said that the front end is pricing too many cuts. The longer end, it faces risk from the deficit, but that belly of the curve is a sweet spot. But I wouldn't forget internationally that there are opportunities elsewhere. And dare I say, we have more of a preference for Eurobonds right now than dollars.
This is the cool. Okay, so Italian BTPs, you have a preference for Italian BTPs over bunds, over French government debt. The French story, of course, is idiosyncratic to some extent. But what is the case behind wanting to load up on Italian BTPs?
Yeah, so the first step is to talk about why euros or sterling beyond over dollar right now, and I would say it comes down to that mispricing, the disconnect between markets and macro that we discussed. The market is expecting 4 cuts in the US versus 2 cuts for the ECB, which I think is realistic. So it is about that kind of more realistic scenario for the ECB. But further than that, even more structurally, real rates in Europe have turned positive. I mean, it's been now since the end of 2022. And then even when we look at within the European rates market, yes, Italian BTPs, the spread of BTPs versus core EGBs has been very stable. And I would say even politically, Italy seems to be quite stable right now. And even some of the macro data that we see in the periphery, dare I say, they look more positive than some of the German manufacturing data, for example. So definitely we see flows into European government bonds. We see flows into European investment grade ETFs, actually.
So investment grade, the love is still there, as you say in your notes for us, for investment grade credit. We're going to have to wrap it up. You have some great calls there. So the love's still there for investment grade credit. You got a call there in terms of leaning into Italian BTPs and the preference of Italian BTPs over bunds and OATs in France. And the belly of the curve when it comes to US treasuries is where you want to be sitting in this environment. The Fed and expectations around Fed cuts slightly over their skis, the markets at this point. That is the view from Vasiliki Pacciatoridi, the analysis there from BlackRock. Vasiliki, thank you. Coming up, a new Prime Minister then for France as we talk about OATs. We're going to discuss Michel Barnier's appointment with the Executive Director of Geostrategic Business from EY and the risk premium on politics that continues to be priced in to French assets. That's next. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Welcome back now. The new French Prime Minister, Michel Barnier, has made a plea for political parties in that country to work together in order to move beyond uncertainty. France, of course, thrown into chaos more than 2 months ago after President Macron called a snap election. Speaking after his appointment, the PM said his new government will act more than talk.
We will act more than talk. We'll try to find solutions coming from everywhere. The government will not pretend to have a superior knowledge. I have learned in my long public life that good ideas come from everywhere, often from the bottom, the most humble of people, when you take the time to listen to them.
Right, for the analysis on French politics and to what extent Michel Barnier's appointment moves things forward, let's bring in Famke Grummuller, Executive Director in the Geostrategic Business Group at EY, joining us from the French capital, Paris. Of course, Famke, thank you for your time. Talk to us about your expectation as to how the appointment of Michel Barnier resets the politics of France and which questions remain, whether it's appointments or setting things up for a budget.
Hi, Tom. Nice to see you. Well, I think there are two aspects to this. From an international perspective, certainly, I think Barnier has great experience. He's a negotiator. He can make compromise. Of course, he's been a long time at the European Union level as a European Commissioner. He negotiated Brexit. So he's very well set up to deal with this extremely complicated political situation in France. We can expect him to, of course, focus on trying to pass a budget, fiscal consolidation, etc. On the other hand, there are many issues in France that will continue to stay, and of course Barnier will take on this challenge, but I continue to see high risk of instability, inaction, an unresolved question around the strength of the Rassemblement National. So I do think there will continue to be big challenges going forward.
And in your notes to us, one line that stood out was you're likely to see work towards fiscal consolidation from this new premier. But that brings me to the point that you've just made, which is the uncertainty around particular alliances and how much support this new premier is going to get. So how likely is it that fiscal consolidation will be achievable in the months ahead for this new premier?
Well, and that is one of the key uncertainties around the situation in France in general right now. What type of coalitions and majorities will we actually be able to see? They will depend very much on the issue. And of course, the first and biggest challenge for Barnier will be to pass a budget without having the government fall. The left in France is furious about his appointment. They have already said that they will introduce a motion of no confidence against his new government. We will, with regards to the budget, we will see a situation where parties might want to bring the government down, but will they want to be responsible for repeatedly bringing it down is unclear. One point about the budget I think that is important to have in mind is that something like a government shutdown in France is rather unlikely because there are ways to make the previous budget continue as long as Parliament passes the authorization for government to collect taxes and borrow money. So The very extreme situation, I think, is not necessarily going to happen, but it will certainly be a very fraught fall.
Famke, in terms of the potential or the mechanics of the politics and the political setup we now have in France, do we assume that we can get some policy process, that we can get some moves around the budget if Michel Barnier aligns with Marine Le Pen's party and Macron's coalition and leaves out the extreme left? Or do the socialists and indeed En Marche, do they need to be bought in, or at least the party, I should say, of the New Popular Front, need to be bought into this? To what extent is this going to be about the right and the centre aligning and leaving out the left?
It is going to probably be a center-right oriented government. And Barnier, I think, arguably, he is, of course, from the center-right, but there will be aspects, I think, of a technocratic government. And he will now work the next days to bring in a broad range of ministers. That will be the first signpost in terms of who does he manage to bring in. Will there be representatives from the center-left spectrum in France, which I think he will try and do. Will he succeed? That will be the first main signpost in question ahead of the budget. Then the next big challenge will be, as you alluded to, collaboration with the far right Rassemblement National. And there will be elements of the other parts of the majorities that he will need from Macron's party and even from parts of the Républicains that at some point might not be comfortable with too much explicit support from the far right. So you can see extremely complex equations here.
Yeah, very complicated, and we're grateful to have you here to walk through it. Very briefly, Famke, before I let you go, we were speaking to an analyst in the markets earlier. He says he doesn't think the risk premium is going to be eroded from French assets anytime soon. What about the business sentiment on the ground in France? Does this improve things, at least in the near term?
I do think in the near term there is some positivity around the fact that we now have a prime minister, that he's an established negotiator, able to maybe forge compromise. That is in the short term. Now, business, of course, make medium to longer term decisions. And what we see is that this extremely high level of uncertainty in France has led business to, for now, pause their decisions. And I believe that business will soon have to see some degree of reassurance and stability. So passing a budget could already go into that direction in order to be able to start to make investment decisions, for example.
Okay, with the analysis on French politics and the implications for business, Famke Krummüller from EY joining us out of Paris. Thank you very much indeed. Coming up, live pictures from Germany, where Ukrainian President Zelensky is speaking right now, as you can see. That is, he's meeting the US Defense Secretary Lloyd Austin on a really important week, of course, for Zelensky after a major reshuffle of his government, of his cabinet, meeting, of course, with that key ally, the US, the Defense Secretary Lloyd Austin. We keep across this story for you. They are meeting at the Ramstein Air Base in Germany. Stay with us. This is Bloomberg.
is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Welcome back. 9:24 in the City of London, bringing you live pictures right now, though, of the US Defense Secretary, Lloyd Austin, alongside Ukrainian President Volodymyr Zelensky, I should say, in Ramstein Air Base in Germany. So Zelensky meeting with key allies, key supporters, and pushing again for the delivery of weapon systems, particularly aerial defense systems that he says are urgently needed in Ukraine. He'll be moving on to Italy and meeting with Maloney after this, but you can see Lloyd Austin there, the US, of course, a key military backer of Zelensky, speaking alongside the Ukrainian president at the Ramstein Air Base in Germany. Let's switch focus to the chip story. Broadcom coming out with a forecast that missed analysts' expectations and estimates, and you can see now the stock pre-markets taking a walloping, down 9.4%. This is not the AI part of the business, it's the more traditional part of its chip business, and the demand there softer than analysts had expected, and you can see pre-market the stock taking a hit. Coming up later in the show, low taxes and regulations. We're going to be speaking about Donald Trump's plans for the economy. Stay with us. This is a Bloomberg.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software.
So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. The dollar weakens, US futures slip as traders stand by for what could be the most consequential US jobs report of the year. The Fed's Daily and Goolsbee say lower rates are coming as the labour market cools. Emmanuel Macron picks Michel Barnier as France's new Prime Minister, entrusting the EU's former Brexit negotiator to end the political turmoil of the past 2 months. Plus, Donald Trump vows to cut America's corporate tax rate and slash regulation, saying Tesla CEO Elon Musk has agreed to lead a review of federal spending. Let's check in on the markets, of course, on a big day when it comes to the data front and our understanding of the health of the US labour market. US non-farm payrolls dropping 1:30 p.m. UK time, with the estimates on the Bloomberg of 165,000, comfortably above that surprise shock to the downside July number that came through. But the whisper number is closer to 140,000. What's the sweet spot for these markets, and what will it tell us about the pace and extent of those Fed cuts? US futures currently pointing lower. It's been a bleak week as well for European stocks, looking to end the week lower. One of the worst weeks for European stocks since the start of August. Moves still into US Treasuries at the front end, the 2-year at 371. Yields down 2 basis points. For the week, down about 20 basis points on the 2-year. The Bloomberg Dollar Index softer as well, down 0.2%. Yen strength, consequences, of course, for Japanese equities and the Japanese markets more broadly as we look to that potential Fed cut on September the 18th. Brent, 73.21, up 0.7%. But for the week, down 8%. One of the worst weeks of the year, flat for the year, and that's despite the fact that OPEC Plus came out and said they will be pushing back their decision and their added oil into the markets, pushing back by 2 months. Despite that, broadly still weaker across the week for oil. Now, hedge fund billionaire John Paulson says he believes the Fed has waited too long to cut rates, but he reckons the Fed will cut rates soon, which should provide a boost.
My best guesstimate would be around 3%, perhaps 2.5%. It's generally beneficial. The major cost when you get a mortgage is the interest rate. So if the cost of mortgages come down, the cost of buying a home would also come down.
While staying with the US economy, Donald Trump has pledged to cut the corporate tax rate, slash regulations, and audit the federal government as he pitched his economic agenda to Wall Street. Trump said he wants to prioritize the country's economy.
To further support the revival of American manufacturing, my plan calls for expanded R&D tax credits, 100% bonus depreciation, expensing for new manufacturing investments, and a reduction in the corporate tax rate from 21% to 15% solely for companies that make their product in America.
Okay, for more analysis on what we've been hearing from President Trump, former President Trump, of course, the Republican nominee, and in fact, Kamala Harris, and how it all squares up. Let's bring in our senior writer, Stephanie Baker, with a finger always firmly on the pulse of US politics and this election. Stephanie, a lot of questions about the tax rate. He's already moved it in his first term, of course. down to 21%. He wants to move it further in terms of the corporate tax rate. So really dividing that line versus Kamala Harris, who wants to move it up to 28%. What do we know about the impulses behind this decision and whether it's fundable, in fact, and how the business world of the US is likely to receive it?
Well, it's part of his America First agenda. You're right, it's not costed. It's going to cost a huge amount of money. He wants to extend the 2017 tax cuts, which are due to expire next year. And he proposed last night this idea to lower the corporate tax rate to 15% for companies that are producing manufacturing in the United States. But that raised a whole slew of questions of how do you define made in America because of complex supply chains. What do you do about cars or Boeing, for instance, where parts come from all over the place but may be assembled in the United States? There's already gaming of the system on that. There are a lot of questions about his tax proposals, and as you said, principal among them, how is he going to pay for it?
Yeah, so that question remains unresolved. But as we mentioned, a clear dividing line now with Kamala Harris. How is that being received? What's it likely to do in terms of poll numbers? Talk to us about the difference that we're seeing in the pitches coming through from these economic policies from both contenders.
Well, Trump outlined a populist economic agenda. He said he wants to get gasoline prices down below $2 a gallon, which everyone would love to see. That's a popular policy. Yeah. So he's saying things that voters want to hear, and he is more trusted, according to polling, on the economy than Harris is. And I think that voters have a certain nostalgia for the Trump economy pre-COVID, understandably so. But I think it's hard to imagine we will ever get to that point again. A lot of the proposals he outlined are inflationary. These sweeping tariffs that he wants to impose on foreign goods, 10 to 20% higher on China. And most mainstream economists believe that will cause inflation to jump and perhaps economic growth to slump. So there's a lot of things that don't add up in his economic proposals. Harris, of course, is proposing to raise taxes less than what Biden has outlined. She is under pressure to give further details on her economic vision, and she will probably come under pressure to do so at the debate on Tuesday. Okay, and that debate is going to be consequential, isn't it? As we've learned, these debates can be significantly important. You talk about the inflationary impact as well, the decision, or at least the policies around immigration could add to that inflationary impact from tariffs as well in terms of the Trump policies. On the funding question, the question of funding, which we touched on, possibly Trump might say, "Well, I'm going to cut my way to be able to afford some of these tax cuts, or cut my way in terms of cutting through the federal government." And he talked about Elon Musk maybe having a role there. We'll take a listen to what he had to say in terms of getting the CEO, of course, of X and Tesla involved.
I will create a government efficiency commission tasked with conducting a complete financial and performance audit of the entire federal government and making recommendations for drastic reforms. We need to do it. And Elon, because he's not very busy, has agreed to head that task force.
Stephanie, is he for real?
It's quite incredible. This idea for this commission actually came up during his Twitter Space event with Elon Musk about a month ago. And now he has come out and moved it further and decided to put Musk in charge of it. And of course, this raises all these issues of conflicts of interest. I mean, Musk runs major companies that are either regulated or funded with U.S. government money. Tesla receives subsidies. SpaceX works with NASA. So there are major questions about how he could effectively run a commission like this without, running foul of conflicts of interest.
Okay, so that's one potential red flag in terms of that possible appointment then, in terms of overseeing a review of federal spending and the role of Elon Musk. Walking us through the politics of the US then, Stephanie Baker, and the economic policies that have been outlined by both candidates. And we look ahead, of course, as Stephanie said, to that debate next week, which will be top of mind for many. Now, oil is heading for its steepest weekly loss in almost a year, and that's despite, as we mentioned, OPEC Plus members delaying its output increase by 2 months. Let's get more and bring in Bloomberg Horizons anchor Jemana Passech, who joins us from Dubai. Jemana, what was the thinking? What do we know was the thinking behind this decision by OPEC Plus to delay the increase in output?
Well, you got to think it's motivated by some of the price action we've seen this week, with oil slumping more than 8%. Brent's getting closer and closer to that $70 mark. WTI actually trading below $70. So there were lots of questions in the market as to how OPEC Plus would respond. And remember, back in June, they announced that these voluntary cuts, the ones that were introduced in 2023 by 8 of the members of OPEC Plus, would start to get slowly unwound as of October the 1st of this year. Well, yesterday they put out a statement saying that the 8 members had a virtual meeting to discuss pushing back that timeline by 2 months. So instead of beginning the tapering of those cuts on October the 1st, they're now going to start on December the 1st, keeping the exact same schedule as they had before, but ending now on December the 1st, 2025. So everything stays as it is. It's just been pushed out a couple of months. So you've got to think that OPEC Plus are looking at some of the price action in the market and feeling a little bit concerned about what the possibility of adding extra barrels back to the market could mean for a market that is already trading quite bearishly. And so what they're doing here is looking to bide a little bit of time. Other notable features from the communique that they put out yesterday is they've also emphasized that they're having some discussions with the 2 overproducers. Those are Iraq, Kazakhstan. Those 2 countries have been pumping more than the quota would dictate. They've talked about the conversations that they've been having in order to urge them to actually stick to the quotas that were instituted, and second, to come up with a compensation plan for the extra barrels that they've been bringing to the market since the beginning of 2024. But of course, that is an important question for the OPEC Plus group. As you think about the timeline into 2025, you've got to think about adherence to those quotas as well, not just the outline of the table of those tapering and the cuts that are expected to come in the next 12 months. You also have to think about compliance.
Yeah, compliance, adherence, does that still hold if we continue to push this back by 2 months? And we know that some members are feeling the pain on this front. What else are you watching for then, Jemana, that's tying in, that's feeding in to oil markets and how they could play out in the weeks and months ahead?
So, Tom, let's just rewind back to the beginning of this week. 2 things happened concurrently. You had weak data come out of China. Those China PMI numbers disappointed to the downside. But simultaneously, you had a geopolitical flaring up. This time in Libya, you had warring governments between the East and the West that led to a shutdown of some of the oil that was coming out of Libya, an impact of about 400 to 500,000 barrels per day. What was the impact on oil? Negative. What does that tell you? It tells you for right now, at this point in time, the market is focused on the demand picture. And as long as the demand picture continues to look bleak, the signals coming out of China disappointing to the downside, softer data coming out of the U.S., further expectations that the U.S. May be looking to enter into a period of not necessarily a soft landing, potentially even a hard landing, all of that dampens the outlook for oil. In addition, you've got to think about some of the seasonals here. We're entering into the refinery maintenance period for some of these U.S. refiners, which means that the overall demand for crude oil is going to drop a little bit. And then, as you were speaking earlier, keep a close eye on the technicals. I was speaking to some options traders yesterday. They say around $70 on Brent, you may see some negative gamma kick in, which means that would put even further downward pressure on the price of oil here. And by the way, Tom, we haven't even spoken about non-OPEC supply, which many have been pointing out for a while now, will continue to increase. You've got more production coming out of the U.S., you've got Brazil, you've got Guyana, which has seen the biggest growth in oil supply growth this year. So all of that adding to some of the negative sentiment that is being factored into the price of oil here.
Yeah, and as you speak, the modest gains that we saw in the session have been erased so far. For Brent, 72.71 right now. WTI still below $70 a barrel. The comprehensive analysis on the oil markets, Bloomberg's Horizons anchor, Jemana Pasechi, thank you. Coming up, the private equity landscape under pressure. My next guest, though, says there are green shoots of recovery. Adam Turtle, CEO of Reed Partners, is up with us next. Stay with us. This is Bloomberg.
is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Welcome back. Happy Friday. Now, the private equity landscape has been marked lately by lower asset valuations, lower deal making, and lower fundraising. That's largely been, of course, due to high rates and geopolitical risks. But my next guest says he is slowly seeing green shoots of recovery. Adam Turtle, who has a touch point on this sector, CEO of Reed Partners, with a number of clients, of course, globally in the UK as well. We touched on the rate environment. Of course, we're all obsessed with what's happening, where the Fed goes, how deep they go, expected to cut, of course, September the 18th. Talk to us about what a lower rate environment will mean for your industry, even as many wrestle with the question of what the neutral rate is, whether it's 3%, 2% or lower, how that affects deal size, how that affects leverage, fundraising. What are the implications of this current rate environment?
Look, I think the rate environment obviously changed dramatically over the course of the last couple of years, and I think the industry has had to readjust to that. I think there is a general expectation that that we've reached the peak of that, and then rates may well start to come down. At the same time, rates ultimately are a commodity for private equity firms. Everyone benefits from the same financing conditions, and what we've seen over the last few years, decades really, is increasing sophistication of private markets managers around how they find deals, how they select deals, and how they grow their companies, kind of regardless of the rate environment that's behind that. And I think that as a consequence of that, we continue to see great performance in the markets despite whatever's happening with the rate environment. I think should rates start to come down, though, that will start to trigger more deal-making activity, particularly at the larger end. I think private markets is a broad market that covers obviously larger cap, but also small cap. And what we have seen over the last few years is probably more interest and focus on the SME side of the industry, where leverage is less of a relevant component of the value creation journey.
And in terms of exits, capital markets, what do your clients say about their expectations around capital markets and that freeze starting to melt around the edges?
Yeah, we're definitely seeing that. I think again the hardest period I think is when there's a lack of visibility about what's going to happen going forward. I think people have sort of adjusted to that now. Things are still somewhat slow, but there is an expectation that you're going to start to see that unfreezing somewhat, particularly as rates start to come down.
And on the fundraising front then, when you speak to clients, either here in the UK or your external and global clients, what are they saying about the momentum that you're seeing in terms of fundraising, and whether that, if there is a pickup, that can be sustained?
So I'd say, we were a couple of years ago in a period that was extremely buoyant for fundraising, very buoyant.
Yes.
I would say almost unprecedented in terms of how buoyant it was, and we actually put data out on this. We have our own data we published.
Was it irrational? Irrational exuberance?
I'm not sure it was irrational, I think, but it was, obviously we were in a period of ultra-low, very loose monetary policy, and so I don't think it was irrational because performance supported it, but it was certainly powered by monetary conditions that were unprecedented, and we're not anticipating are going to happen again, even with a reduction of interest rates. So what we've really seen is a shift from what I would consider almost the blip rather than the situation we're in right now. I've been doing this for a long time. The market conditions we're in right now aren't easy, but then fundraising shouldn't necessarily be easy. And what we are seeing, again, when we look at the data that we publish, is a slow recovery in capital deployment to the segment and a continued real interest from institutional investors in committing to the segment.
And on valuations, where are we there? Is there more catch-up that's needed, that's expected in terms of valuations in the private markets versus the public markets?
I think we are continuing to see exit activity, and when that's happening, the value, at least amongst the client base that we see, those valuations are being borne out in the valuations they were holding are being borne out in the exit activity that they have. Clearly, and we have seen a recovery in valuations in the public markets. If you look at from that perspective, so I think that the valuations, are solid, but I do think that what you really want to see is more deal making, because that will trigger more exit activity.
How do you define and quantify the risks within this space, given the complexity of some of the deals now? People like Jamie Dimon and others have compared the private credit markets now to kind of great global financial crisis. Is that taking it too far? What is your take on the risks within private credit?
Look, if you're looking at private credit, I definitely disagree with that. I think that, one of the big positive developments is the development of a robust private credit market where you have sophisticated financial investors agreeing to tie up their capital for the long term to support managers who are supporting companies for the long term. So I think there's the asset liability match is there in private credit, and it's a profoundly good thing for economic stability, if you like, that market has developed. I think the underlying investors in these segments are thoughtful, sophisticated, and quite involved and close to their managers. So I think they do understand the risks that are taken. And so I don't see every sector, every market, every ownership structure can have underperformance. That's part of life.
Okay.
But I think the structures and oversight in this segment is actually very good.
Okay. Adam Turtle, thank you very much indeed. An important time to touch in on what's happening in terms of private credit and private equity, of course, as we expect rates to edge lower. Adam Turtle, CEO of Reed Partners. Coming up, how Greece is using technology to live with wildfires that have now become a regular occurrence in that country across the summers. Stay with us. That is next. This is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Welcome back. Now, Greece is experiencing its worst wildfire season in 2 decades. And while authorities are looking at ways to prevent fires, the country is also learning to live with them. Joining us now is our Athens Deputy Bureau Chief, Paul Tugwell. Paul, why does Greece seem to be, at least on some measures, doing better in terms of controlling and managing these wildfires that seem to be becoming an every-year occurrence for this country?
The simple answer is investment in technology. The government announced in April a procurement program worth 2.1 billion euros for buying various pieces of firefighting equipment, but particularly drones, and that's made a big difference this year. These drones operate on a 24/7 basis, flying in Greek skies, particularly over Athens and its greater Attica region where the bulk of the Greek population lives, and they have enabled the fire department to detect fires much more quickly, which means they can react much more quickly, to the extent that they can respond to an outbreak of fire within 5 to 10 minutes. And that has really helped them contain fires compared to previous years.
Okay, so monitoring and the rapidity of the response then from the authorities. Is it a depressing reality that Greece will be seeing more wildfires in the years ahead, Paul?
Unfortunately, I would say yes. Already this summer was the hottest ever globally. The Mediterranean in general was particularly hard hit, and that obviously includes Greece. So we're seeing longer summers, drier summers, with temperatures increasing and above average all the time. But also, the climate change means that we're seeing less rainfall in the winter and in the spring, which means we enter the wildfire season, which officially begins on May 1, in a worse situation every year. The conditions are such that it's easier for fires to break out. Climate change, of course, also means there are other extreme weather patterns that include storms, and we had several of those storms this summer in Greece. You may say the rain should help in terms of extinguishing fires, but in fact they bring lightning, and lightning strikes have triggered many forest fires this year.
Okay, Paul, got to leave it there. Paul Tugwell, our Athens Deputy Bureau Chief, checking in your markets on a big day, of course, with the non-farm payrolls print. Bonds bid, equities down. Stay with us. This is Bloomberg.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Good morning from our global headquarters in New York. I'm Manus Kani alongside Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
The last piece of the jobs jigsaw drops today. Non-farm payrolls expected to show a hiring bounce. And warning signs from Chicago Fed President Austin Goolsbee. He sees the potential for multiple cuts over the next year. And another chips setback. The U.S. doubles down on China's semiconductor access. Broadcom sales forecast disappoints. Good morning, Manus.
Danny, good morning. There seems to be a preparation for pessimism on these jobs numbers. Only two numbers you need to keep in mind. 165, which would be a jump from July, and 4.2% on the unemployment rate. You have this preparation for pessimism. You're looking at the NASDAQ down 1.25%. Broadcom is down. The chip sector under pressure again. More curbs coming from America towards China. What is the reverberation of that? Yields really trying to find their mojo. This market is one breath away from a 50 basis point cut, and as Goolsbee says, multiple cuts along with Mary Daly. We'll talk more about that in terms of the narrative, but this market is one breath away, or one non-farm payrolls away from that 50 basis points potentially being a reality. The dollar is on the back foot. Yen is much stronger this morning. Kuroda, of course, the former governor, talking about the neutral rate in Japan. Wouldn't quote the level, but he did say it's nearer to 1.5% to 2%. So there's a mile to go to higher rates in Japan. Danny.
There's so much emphasis being put on today's jobs report that happened at 8:30 a.m. And you mentioned Goolsbee. The thing that stuck out to me of what he said, Manus, was this. I don't want us to be basing decisions on one data point. Basically pushing back against the idea that the data point today is going to be the determining factor between 25 and 50 basis points. So is the market putting too much importance on it?
Look, I think we become very myopic because it does hold a great deal of significance. Suddenly, we do look at ADP a little bit more and the jobless claims. Daly talks about a downward descent, and I think we're going to hear from Williams, we're going to hear from Goolsbee again a little bit later on today around the jobs report, but it feels very precarious. You know, it's, as I say, we're one bad print away from cementing a 50 basis point cut. That's very much a live proposition.
Well, part of the reason people are so nervous is because of what happened last month. Let's be honest. After you get the jobs report, you have a yen that slides, dollar yen that slides to 144, the worst day for Japanese equities since the 1980s. But is this time different? The data hasn't been as negative over the past week. Jobless claims wasn't that bad. You had ISM services come in strong. The data is a little bit more uneven than last time. And you had that BOJ hike last time, too.
I thought it was ironic. You suddenly get people really hanging their hat. And indeed, Andrew Hollinsworth will be with us from City a little bit later on, talking about the Beige Book. 9 out of the 12 districts. Suddenly, the Beige Book takes on a whole new meaning. Paul Donovan at UBS, I think, encapsulates it beautifully. It's the fear of unemployment, and that negative feedback loop. So long as companies are not cutting jobs materially, then that fear perhaps lies in abeyance.
Yeah, really looking forward to that conversation with Andrew Hollinsworth from Citi. So it was the rupture caused by last month's jobs report, and now traders are bracing for the next round of data that happens again, 8:30 a.m. Let's get over to Bloomberg's Rachel Evans. Rachel, what's at stake?
Yeah, well, I think you guys laid it out very nicely. It's really this question of whether we see a 25 basis point cut or a 50 basis point cut being priced in after the jobs data. I think traders are really going to be watching to see to what degree we either get a miss around that kind of forecasted 165,000 level or a beat over that. Do we see some of the data that's kind of suggested that the US economy is holding up well? Is that kind of confirmed by, a suggestion that maybe the last jobs print was an aberration and that the labour market is also holding up well? Or do we see that deterioration that we were hinted at in that kind of previous report, which prompted, as you pointed out, so much kind of turmoil in the market? Is that something that we see kind of come through again? And we've really seen kind of like the market positioning for that over the last few days. People are very long, treasuries in particular, expecting to see some confirmation that we are going to be heading towards those bigger cuts. So the market is geared towards expecting to see kind of a miss, a lower print in the jobless claims today, in the jobs data today, whether that's on the unemployment side or on the kind of like key payrolls figure itself.
Yeah, it does feel pretty precarious at the moment. The issue really is to whether a Goldilocks narrative can be affirmed or whether we're going to something deeper. As Citi says, they've shifted to a recession, no longer a Goldilocks scenario. How quickly we've pivoted.
Yeah, I think that's it. I think that the market has really had to start pricing in this deterioration very aggressively. We've seen kind of 2-year yields, the most sensitive to interest rates, moving down 80 basis points over the last 6 weeks or so. That's a huge sum that we've already kind of seen rates rally. So I think the question mark is now going to be how much further can people position for that recessionary environment? It seems like the soft landing is still something that the stocks market in particular is kind of pricing in. Do they start to actually price in that harder landing? The bond market has already rallied so far, and we've already got, I think, 110 basis points of cuts priced in for this year. That's at least a 50 basis point cut once, maybe even twice. So to what degree can we actually see, more bearishness in the market, more dovishness priced in, given that we're already expecting quite a large number of aggressive cuts this year?
Yep, it's surely true that the bond market is prepared for a pretty bad print. Rachel, thank you very much. Rachel Evans, the Bloomberg reporter. State Street's Maria Waitman joins in the narrative, the impact of today's jobs data, writing this. Labour market is not a source of inflation. This is a perfect message for the stock market. It means that the Fed will be cutting rates to support the labour market, which equals the economy, which equals the stock market, at the sign of further weakness. Maria joins Danny and I now. So, Maria, just listening to the setup there, the bond market is prepared for a pessimistic print. Do you think the equity markets, I know they're dipping this morning, but are they still holding on to Goldilocks for dear life?
Yes, hello. I think I really want to agree with what Danny was saying in the kind of introduction is it's not about what we see today. It's about kind of overall labor market. Yes, we know labor market is softening, and but it's not collapsing. We are not saying people huge layoffs and huge drops in corporate profitability and bank lending and things like that. Yes, we are slowing, we are adjusting. That's exactly what central bank wants. And what Fed told us is that if we see further deterioration, if we see a big concern, we are there to step in. So I really struggle to see a more positive message for equity markets that any central bankers could have given us. So yeah, I'm trying to stay constructive.
Maria, this is my favorite line from your writing, which I think encapsulates where you are right now. Bad news is good news. Good news is good news. But very bad news is bad news, if you can kind of wrap your head around that. So the only scenario that's bad for equities is very bad news, essentially. Maria, what constitutes as very bad news? What is the bar for that?
Oh, well, we probably need to see negative payrolls. Then, okay, labor market is really bad, and we're really going into really serious slowdown. But I mean, looking at the various different data sources, okay, corporate earnings were okay-ish. I mean, we had positive surprise, we have negative guidance, but we're not saying terrible things. Consumer spending, again, consumer is spending, yes, a lot of it on credit card, a lot of it in maybe cheaper goods, but we still spending. Bank lending, okay, it's not growing, it's kind of slowing, but again, it's not complete deterioration. So to us, it's not really that very, very deep recession. And even if that happens, I mean, we don't see huge imbalances in the economy again. So we still see liquidity, we still see lending. So we are really going for kind of not bad news.
Not bad news. Okay, well, let's see how bad the news is today, because the bond market's saying one thing, the equity market is saying another. You say it's too soon to rotate. Why?
Yeah, that's a really interesting question. And I have to say, I've been asked about small caps and value stocks and cyclical and non-US stocks again and again and again. They have really underperformed for a long time. We've seen signs of rotation there. My big concern about this rotation is that yes, we're having potentially Fed put. Yes, we're having big sell-off in tech. So where do you go? I question small caps, because that's where we see the biggest weakness in earnings. Yes, we had investors were disappointed with tech earnings, and Nvidia profit margins were only 50%. I mean, look at small caps. They're actually places where they're losing money, and we're seeing really, really significant earnings downgrade. So no, I don't want to go into those stocks. I want to stick to quality. I want to stick to large caps. That, to me, a better protection if something happens. So that rotation you don't like, but I even wonder within large caps, you have seen this bid to bond proxies. Utilities up something like 5% over the past month. The real estate is up 13 percentage points versus tech, versus the wider market rather, since mid-May. Can these sectors continue their outperformance on just that assumption that the rate cuts are going to come and they're going to continue on? Yeah, real estate is something that I actually quite like, and mostly because of investor positioning. We know that investors are super underrate real estate, and you said that, like you said, it's rallied 13%. So anybody who has this underweight in their portfolio, they need to close, they need to buy, and this buying will continue until at least we go back to benchmark. And our data suggests that investors are still very, very deeply underweight. I mean, the other place we like maybe pharmaceuticals, so that's your large caps, that's your quality. That's very strong cash flows. Again, places that we like right now. So quality and size are. So maybe if you're not as bullish and huge tech lover as myself, maybe healthcare is a good alternative. Well, we like the fact that you're a constant barbell, tech on one side, and cash on the other. Look, utilities, just to pick up on what Danny said, are up 21% on the yield. The dividend there is near 3%, so it's almost double the broader market. If in an AI play, you're looking for alternative slots in AI, that usage of electricity, that usage of energy in a hungry AI world, can that be part of that utilities narrative? I mean, potentially. I mean, I'm not 100% bought on the story, because the reason tech is making so much money out of AI, because they invested enormous amounts of money. Utility companies, yes, there would be a huge demand, but they still need to invest. That investment has not happened. The infrastructure is still kind of not there. Yes, demand increases, but you need to invest, and then kind of generates a huge return. So I think utilities would be quite a way below my ranking behind tech. Hey, Maria, let me just say, in a market setup that feels dour, it's wonderful to hear your bullishness today. It's a nice dose on this Friday. Maria, we appreciate it. Good luck for the report later today. State Street's Maria Waitman. Okay, Manis, let's talk about some of the other top stories that are trending on the terminal this morning. Apple has greenlit a version of Tencent's WeChat app ahead of the iPhone 16's debut that does buy more time for negotiations between Apple and WeChat over App Store fees. In a pitch to Wall Street, New York's corporate leaders, Donald Trump, pledged to cut the corporate tax rate to 15% for companies making products here in the USA. Trump promised to, quote, low regulations and low interest rates.
China is combining two of its largest state-backed brokerage. The aim, create a new giant that can compete with overseas financial firms. The deal is pending approval from the company's boards, shareholders, and regulators.
Coming up in the show, the U.S. targeting China with fresh chip export curbs. That's hitting the chip sector this morning.
And later in the hour, we're going to sit down with Citi's Andrew Hollenhorst as we count down to the August payrolls report here on your Bloomberg Brief.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. It's Jobs Day, and Bloomberg has the report under surveillance.
It's from super hot to solid.
This is normal.
I think people underestimate the behavioral aspects when it comes to the labor market.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
So what is bad on September 6th?
Nobody really has a full answer on it.
I don't know what counts as good news these days.
It's a big debate.
The August Jobs Report, today on Bloomberg.
You're watching Bloomberg Brief. Danny Berger and Manus Cranny in New York. So chip stocks leading futures lower this morning. Broadcom down some nearly 10%. We'll talk about that stock individually in a moment. But in the meantime, the bigger story, the U.S. is joining its allies in imposing chips-related export curbs that target China. Let's bring in Bloomberg's Tom McKenzie on this. Tom, another day, another headline about export curbs on chips to China. What's different this time?
Yeah, that's certainly what it feels like, doesn't it? And in terms of the direction of travel, we should expect these measures to continue. Here's the difference then. October 2022, that was the earthquake moment in terms of this tech battle between China and the US. That's when the US imposed these restrictions, not just on hardware, but on software, the machine tools and the software and the exports of those to the Chinese market, as well as some of the high-end, cutting-edge semiconductors as well. This new announcement that they're considering and that they're looking at is around aligning the US with its Western allies largely, but also Japan, the UK, and the Netherlands in export controls of quantum computing, both software and hardware and other elements within the semiconductor space. So it's a slightly different area that's being targeted, quantum computing, where the US and China are neck and neck in terms of developments and potential consequences for the militaries of both countries, and then additional elements within the semiconductor space that are caught up on this. This is not a US initiative. It's them playing catch up to some extent in terms of export controls that are already in place here in the UK, also in the Netherlands and Japan. The BIS, the Bureau of Industry and Science, in, of course, the Commerce Department, saying this will make it significantly more difficult for our adversaries to develop and deploy these technologies in ways that threaten our collective security.
Interesting that yesterday was Nippon Steel was a potential security threat to the United States of America, and today it is come on side and support us in our harry against China. One stock which is under pressure this morning, Broadcom. Now this comes down to their guidance on AI and non-AI business. Differentiate for us.
Yeah, look, this is a stock that's up about 60% year to date. It's clearly under pressure right now, pre-market, as you say. They actually beat in terms of the earnings and in terms of expectations around AI deliveries, the AI chips and components they supply around that business, that division, that actually came up in terms of their expectations above estimates. As you say, it was the forecast around the non-AI divisions that disappointed, and that's what's leading to pressure on the stock. Interestingly, executives said that they think they've got to the bottom in terms of the challenges and the headwinds facing the non-AI divisions of the company. Nonetheless, you're seeing that pressure come through. Morgan Stanley, though, amongst the analysts going through these data points and these earnings, saying they think there's upside here. They've raised their price target to $180 for the stock. They say it's clear that the turnaround is starting to happen in the non-AI parts of the business. Yes, they say AI demand will be non-linear, but the demand is still there.
While we're talking about disappointments, Tom, Intel has been really struggling, starting the week with some 9% decline last week, rather, when it had some of its earnings, and now it's exploring a sale in Mobileye and its stake there. Qualcomm is maybe eyeing up its business design. What sort of contours are we getting of a company that is trying to right-size itself?
Yeah, this is a pivotal moment for Intel, the most consequential moment, arguably, in its 56-year history. And we've had this drip feed of leaks, reports being covered by Bloomberg, Reuters, and others, as you say, around the options that are being put on the table at this company. Pat Gelsinger expected to update on those options in the days and weeks ahead, and that's why we're getting this drip feed. One line coming through then, they have this 88% stake in Mobileye. This is this autonomous driving software and hardware business that struggled on its own. They have an 88% stake. They're looking at maybe releasing some capital and some value by selling down that stake. We'll see if that happens. And as you say as well, some of their clients, some of their competitors, the likes of Qualcomm, looking at parts of their business as well. So it seems like Intel are putting all the options on the table in terms of trying to restructure, resize this business. The foundry push continues, of course. Citi, though, putting out a note saying they think ultimately the chances of that strategy being pursued by Pat Gelsinger around building out foundries in the US has minimal chances of success.
Yeah, it's got all the smell of a fire sale at the moment, hasn't it? And you just look at the performance on Mobileye, down 70% this year. So the vultures are circling. Tom, thank you very much. Tom McKenzie picking over the bones of Intel and the assets they want to put up for sale. Coming up, Berkshire sells another chunk of Bank of America. Why? Well, we'll have a chat. This is Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Brief on Jobs Day. I'm Menace Cranny alongside Danny Berger in New York. Front pages. Let's kick it off. This is what we are checking out. We've got the Financial Times. NVIDIA's AI chips. They're cheaper to rent in China than they are here in the United States of America. It costs $6 an hour to rent a server with 8 NVIDIA A100 processors for cloud services in China. And the same cost here, $10 in the US. So the difference signals advanced processors are easy reaching the Chinese market, despite these controls and renewed controls again this morning from Washington.
Probably not happy about that story. No. So next up on the Journal, Bank of America shared non-public information with investors in India that, according to a whistleblower, so company records reviewed by the Journal showed that bankers contacted investors via WhatsApp in March before a $200 million share sale. The bank is investigating those allegations.
And final story, Warren Buffett, Bloomberg's leading with this on Bloomberg.com. His haul from Bank of America, his sales total nearly $7 billion. It's been chipping away at this over the past couple of months, Danny. Liquidated another $760 million since Tuesday. I mean, this comes down to, what is it that's motivating Warren Buffett? I mean, if you've been long, he's been long since where? $5 multiple years ago. So this is what you call return on equity.
Yeah, 2011. I wonder if it's because he sees higher taxes. I was looking through his May shareholder meeting. He said higher taxes are quite likely. The government may decide that someday they don't want the fiscal deficit to be this large. And in order to do that, they're going to take a larger percentage of what we earn. We know Kamala Harris is pitching a 28% capital gains tax. I don't know, could be something in there that maybe he's trying to get out ahead of it.
Listen, this is a very, very smart investor. Either way, he's not bothered about the first 3 months. Apparently, Charlie Mayo over at Wells Fargo said in the first 3 months, after you've got the rate cuts, the cost of your deposits go down, you get a nice boost on the banks. It's the following 3 months, you maybe want to be a little bit more shade when it's tough.
Fair enough. Mike Mayo there, always very animated. Okay, coming up, it's game day. It's jobs day. We're going to catch up with Citi's Andrew Holland-Horst on your Bloomberg Brief.
Well, I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investments that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issues, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient, while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
It is the last piece of the jobs jigsaw drops today. Non-farm payrolls are expected to show a hiring bounce. Warning signs from Chicago Fed President Austin Goolsbee. He sees the potential for multiple cuts over the next year. And chip setback, the U.S. doubles down on the China Semiconductor Access Broadcom sales forecast. Disappoints. Danny, good morning. The potential is there from Goolsbee. We'll hear more from him later on today, along with Williams after the jobs report.
Yep, Williams, Waller, those will be interesting to hear from. 11 a.m. is the time to pay attention to that. Two-year yield continues to drop 3 basis points this morning, lowest in 2 years. The setup is very clear for this bond market of how it's been trading going into this report, continual buying of bonds. Equities weaker this morning, down by 0.6%, weak across the board. Is this a potential for a squeeze if there is a more positive report, considering the dourness of the trade over the past week? Tech really underperforming this morning, Broadcom falling by some 9.5% after its earnings report. Dollar also weaker this morning versus the yen, down about 0.5%. This off the back of those comments from Goolsbee, Manus, saying that he's really concerned about the labor market. Multiple cuts may come. The interesting thing is at 142, the dollar is actually weaker at this point than where it was last month, post that little mini crisis, post the BOJ hike. So that carry trade, it hasn't been a rupture, but kind of a slow bleed ever since then.
Look, absolutely a slow bleed. The dollar has been on the back foot, and I think you're right. The risk reward going into this jobs report is that if you get anything a little bit better than the market is expecting at 165, that is going to reinvigorate Goldilocks and perhaps push back on some of those dramatic moves very much at the short end of the curve, which is it feels as if we're in a precarious moment of where we're like one breath away from ratifying a 50 basis point cut.
Yeah, I mean, we're so skittish about this report, but I go back to what Goolsbee said yesterday. I don't want us to be basing a decision on one data point. So it leads to this question: is the market overweighting the importance of today's report? Maria Waitman certainly thinks so at State Street, but that being said, she's incredibly bullish. So basically anything would make her want to buy stocks.
I like what she said, which, you know, bad news is bad news, but it's got to be very, very, very bad news, which is almost like a negative jobs trend, which nobody has put on their dance card for this one. So at the moment, I think it's going to be that fill or kill on whether it is 50 or 25. Joining us to put some context around the numbers, it is Mike McKee. He is with us here here this morning. Mike, good morning to you. So as Danny said, the risk reward here is 114 last month, 165 is consensus here. Maybe we should be a little bit more focused on the unemployment rate and what's driving that.
Well, the unemployment rate is the #1 indicator that the Fed has cited for their thinking. Now, the question is, do they care about how far out unemployment goes to 3 digits or whatever? Will that influence them? We are looking at 165,000, as you say, although interestingly enough, you said Wall Street's thinking. Wall Street is thinking 150. That's the whisper number. It's the economists who are thinking 165, which surprised me because we've had a lot of negative jobs numbers in some of the other indicators this week, and nobody has really changed their forecast. But 4.2% is the unemployment rate. That would be a tick down from last time. And there are a lot of questions about whether last time was unusual. If you go under the hood of the unemployment rate, most of what we saw, or a very large part of what we saw in terms of the unemployment rate rising to 4.3% last month, was because a lot more people were listed as on temporary layoff. That is the light blue on the, if you look all the way to the right, actually it shows up on your screen, I guess, as sort of pink mauve, sort of like Danny's jacket
I'm
color.
matching it, yeah.
Yeah, she matches it. The increase there is expected to reverse. A lot of those people may have been auto workers who were out of work because of plant retooling, and some of it is weather. And if that happens, we could go down to 4.1. If we go above 4.2, that's what's going to scare people. And the question then is, did we go above 4.2 because we got to a rounding situation, or because, you know, we got out to 3 digits and rounded up to 4.2 or 4.3, or because we actually saw the rate jump that much?
Got you.
Yeah, so I love every time you give us the jobs data, you need to tell us by like the 100th or even the 1,000th of a percent.
It's gotten to that point.
It really has.
Andrew Hollenhorst is here, and we were talking about that earlier before the show. It's like, is this a way to make policy on the 3rd digit?
Okay, but is the Fed making policy based on that, or is this just a market that assumes that they are?
Well, the Fed is going to have a lot of things to think about. I mean, imagine you're in that room. Not only do you have what's the trajectory of the labor market, and what's the trajectory of growth going forward? Where's inflation? But we also have the geopolitical stuff out there, and you've got the election, and we don't know how that's going to influence it, and monetary policy isn't going to hit if they do something till next year. So they've got to juggle all this stuff in there, so maybe a 3rd digit doesn't matter so much. But it'll be interesting to watch today. You look at Fed funds futures and overnight index swaps right now, they've actually come in a little bit, fewer than 1.5 cuts now. So we'll see where they end up at 8:30, and then the yield curve is disinverting again.
Twice in the space of a month, you know?
So where does that go? Things to watch today.
Mike, looking forward to you breaking the data. Let me know what color charts you're going to use after the data breaks so I can make sure I can match it again next time.
You did a great job today.
Thanks, Mike. Okay, Mike McKee there. And later today, Acting Labor Secretary Julie Su will be joining Bloomberg Open Interest at 9 a.m. New York time. Let's get another estimate for what we're likely to see today. Citi's chief economist Andrew Hollenhorst sees 125,000 jobs added in August with the unemployment rate at 4.3%. He goes on to write, this would confirm that softer July data was not just due to temporary factors, but rather reflects true weakening in labor market demand. We expect this to lead the Fed to cut by 50 basis points in September. Pleased to say Andrew joins us now. Andrew, thanks so much for being in here nice and early this morning.
Yeah, my pleasure.
So you've said for some time that the bar to cut for 50 basis points is lower. It's certainly lower than many folks would see out there. Is there any piece of data today that would convince you it's 25, or is it clear we're on a course for 50 basis points worth of cuts?
Well, I think there are two discussions here. One is kind of what is the trajectory of the labor market? What does the Fed need to do? We heard that from Chicago Fed President Goolsbee last night, I think being very clear that it's the time to cut now and that there will be multiple cuts coming. Then there's this question on what the Fed would call tactics. Are you going to cut 50 basis points or 25 basis points when you start the cutting cycle? And that will depend on today's jobs report. And like Mike was discussing, it could come down to hundredths of a percentage point on the unemployment rate. 4.3%, I'm very convinced they're going to cut 50 basis points. 4.2%, probably a 25 basis point cut. And we have all these marginal cases. We'll be listening to Williams. We'll be listening to Waller. What are they going to tell us?
So this is how nuanced it has become, as we've just said. It's whether it's rounding or whether it's actual. Talk me through your thinking and what is it that's pivoted you from Goldilocks soft landing to a recession? Because the market's gone from 6 cuts to virtually no cuts to 4 cuts and now 50 basis points on the docket. So what tripped you over from Goldilocks to recession?
Yeah, so we've been consistent on this, thinking that the Fed raised rates to restrictive levels. That's meant to slow the economy, and that would happen with maybe a significant lag. And I think those lags have just caught up to us now. So what we've been watching over the last 6 months is a consistent story in the labor market. And I think that's where we should really be putting today's single monthly jobs number in the context of an unemployment rate that's risen almost 1 percentage point. So it's not just the July report that we're talking about and what happens in August. It's really this transit upward in the unemployment rate. What we saw in the JOLTS data earlier this week, where we have the hiring rate that's come down and hiring that's very subdued. So I think what a lot of people are looking at now is a job market where they're saying, well, we're not seeing these big layoffs, so things must not be that bad. And that's true right now. The problem is, as that hiring rate comes down, it's telling us that firms are becoming less and less excited about growing their labor force. And the next move that you typically see in a cycle is that move towards layoffs. So I think that's what we should all be concerned about here.
Well, and you mentioned this earlier in the show, Manus, that Paul Donovan of UBS has this whole thing where it's like the number itself doesn't actually matter. It's people's perception of the number and whether people start making decisions based on if they feel hiring isn't as robust. How close are we to that sort of environment where consumers think, hey, if I leave my job, I'm unlikely to get hired, or if I don't have a job, I'm unlikely to get one, and I will change my behavior based on that?
So those are some of the concerning numbers that we're seeing now. If you look at some of the survey numbers, people are saying they're finding jobs harder to get. They're more worried about losing a job. That does affect behavior. And again, as you're going through this cycle, you're looking for, have we hit that inflection point? Have we hit that inflection point where people actually pull back on their spending because they're worried about their job prospects? I think we're close to that now.
You talked about the acceleration in unemployment going up by 1% over that period of time. Are you expecting a shallow and short dip in this economy or something more negative?
Well, I think we will see the unemployment rate that not only moves higher, but accelerates higher because we have these kind of typical nonlinear dynamics. Last month, part of what we were talking about was the so-called SOM rule being triggered or almost triggered. And that is this empirical regularity where what looks like a soft landing, what looks like a very slow softening of the U.S. economy tends to accelerate. So I think we're right at that point now. And again, that's the context in which I'm viewing today's report.
I mean, you have a very holistic view of things. Just to get back to this idea that hundredths of a percent or thousandths of a percent make a difference for the Fed, are we just missing the forest for the trees, essentially? Have we gotten too bogged down in the data? And I ask that has the Fed and has the larger investing community done it? Because there's a differentiation between what we think the Fed will do versus what they actually do.
Yeah, I think this is so similar to what we did with inflation, where we do all this work also, right? You do the very detailed work on inflation. You look at all the subcomponents. You try to get those hundredths, those thousandths of a percentage point right, because you want to figure out where the number is going to come in. That is going to determine what the Fed is going to do. But then you also need to then step back from that analysis and say, where is the trend in this data actually going? We see this clear softening trend in the labor market. That's what Goolsbee was talking about. That's what Powell was talking about at Jackson Hole. I think that's just very, very clear now. Now, there is a really interesting discussion around these temporary layoffs. Are they going to be really temporary or more persistent? Those are interesting stories also. We want to be watching for those things in today's number, but I think this bigger macro trajectory is more important.
So the the deceleration that you're talking about then brings into question how quickly we get to neutral and where that is. Paulson was here yesterday, John Paulson, talking about 2.5%, 3%. How quickly do you think this cutting cycle could become?
Yeah, so I think we could really accelerate the cutting cycle, and we see the market pricing some probability of that, right? They could go 50 in September. Not only could they go 50 in September, they could go 50 again in November, and if the unemployment rate continues to rise, why wouldn't you? And I think that's what I come back to when I think about the Fed. Pretty much every Fed official...
But that's the unwelcome softening that Powell does not want.
That's the unwelcome softening. They would not welcome any further softening of the labor market, and they all think that policy rates are restrictive at this level. So if you think you're restrictive, you don't want any further softening, why wouldn't you be reducing rates pretty rapidly?
what difference does November make, the outcome of that? If you have Trump yesterday talking about lowering corporate taxes by 15%, emphasizing that he wants to use tariffs, divergence from Kamala Harris, who wants a 28% capital gains tax. So what difference would that make for the outcome of 2025?
I mean, I think we know how the Fed will respond to this, which is that they will try to stay as far away from this as possible. And essentially what they'll say is, all future policy is uncertain. We're going to wait until we see not just the future policy, but how that policy affects the economy. Because even if we knew exactly the policy, you could have a couple different economists on this show, and they would disagree on what the economic effects are going to be.
Can we just close off? There's the disinversion a couple of times in this yield curve. How important is that for you? Just briefly, just round it off for us.
Well, I mean, we've been inverting and disinverting intraday, right? Just watching that. Yeah. So, I don't think that, are you plus 1 basis point, minus 1 basis point on the slope of the yield curve is the important point. The important point is that we're at this inflection point in the labor market. As we're hitting the inflection point in the labor market, we're hitting an inflection point in interest rate markets, and you're seeing that curve disinvert. It's all consistent.
Andrew, thank you very much for being with us this morning. That's Andrew Hollenhorst of Citi. Coming up on the show, U.S. targets China with fresh chip export curbs. We'll discuss the implications on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Names in global leadership are on Bloomberg.
We are 40 million. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the U.S. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
It is Bloomberg Brief. I'm Manus Granny alongside Danny Berger in New York. Well, the chip stocks this morning, they lead the futures lower. The U.S. is joining its allies in imposing chip-related export curbs targeting China. Let's get to Tom McKenzie. He's been tracking the story for us. Tom, when we look at this story, just how much of an escalation is this? It sounds as if it's focused on the higher end and around quantum computing, but just run us through the escalation of these curbs.
Yeah, so this is a plan by the US to, on some levels, catch up with its allies, including the UK, which put in similar measures in April, but also Japan, more importantly, and the Netherlands. This is a worldwide export ban, then, restriction on elements, hardware and software, that go into quantum computing. So that's a new element. They haven't targeted quantum computing before. And then some of the hardware still within the semiconductor space. Now, there are carve-outs, and the carve-outs are important. The carve-outs are for those allies like Japan, like the Netherlands, that have put in place similar restrictions, export controls. And that is something of an incentive for others to get on board with these measures, because if you don't have access to the technology from the US, it's very hard for you to innovate in that space. But yes, China will be part of the target, of course. We had a statement coming through from the Ministry of Commerce, the Department of Commerce in the US, saying that these measures will make it significantly more difficult for our adversaries, and of course you can put China in that category, to develop and deploy these technologies in the ways that collectively or affect or threaten our collective security. So it's an additional measure. The most consequential will go back to October 2022, when you had the ban on everything from GPUs coming through from NVIDIA, the A100s, the H100s, plus the hardware, plus the software, and the ability to maintain those pieces of equipment on the ground in China. That was the earthquake moment in October 2022. But since then, we've had a rapid catch-up in terms of tightening these restrictions, and this is a further step in that direction.
And then we had Broadcom yesterday, Tom, down nearly 9% in the pre-market trade. It was a forecast that disappointed. What was behind that disappointing forecast?
Yeah, look, here's the context. The stock has rallied year to date, right? 50, 60%. Now it's under pressure. The earnings for the quarter were a beat, but it was the forecasts, and particularly the forecasts around the non-AI divisions of Broadcom, because this is an expansive business, and that's where the concern were, because those forecasts, 14 billion versus 14.1 billion, clearly a miss. In terms of the AI divisions, though, the outlook for that sector and that segment of the business was actually more positive than the analysts had expected. But they clearly focused on the supply that Broadcom has in terms of software and hardware in parts of this ecosystem above and beyond the AI part that's done so much to power the stock higher. So you're seeing that pressure come through for the company. It's interesting that the CEO said, look, in terms of the downturn, the headwinds for the non-AI divisions, so supply, for example, to EVs and cars, as one example, that has started to bottom. He sees a brighter picture ahead. And some of the analysts out there, including Morgan Stanley, agree with that view. But for the moment, clearly the stock is under pressure.
Tom, appreciate it. That is Bloomberg's Tom McKenzie. Okay, a quick check on the bond market. We are counting down to the payrolls data, and whether it means 25 or 50. 43% odds of a 50 basis point priced into this market at the moment. Two-year yields are trading at their lowest level in nearly 2 years. 10-year yields are at their lowest since 2023. That trend continues across the curve lower by about 3 basis points. So it is a highly anticipated jobs report and the ensuing rate decision 2 weeks later. And even with that uncertainty, the debt market has been the winner. It has been absolutely gangbusters. $43 billion priced on Tuesday. This week has been one of the busiest for U.S. investment-grade bond issuance since 2020. Let's bring in Bloomberg's Ronan Martin for more on this. Ronan, it's a period where there's a lot of macro uncertainty, but corporates are not waiting. What's behind all the issuance?
Yeah, it's been crazy busy. We've seen 55 billion euros in Europe this week. That's following 63 billion euros last week. As you said, a record day in the US on Tuesday, and they're up to about 80 billion this week already. It's the 5th busiest week over there. And that's kind of following the crazy weeks during the height of COVID when companies are desperate for cash. Even Asia, we've had the 2nd busiest week for APAC issuers doing US dollars. And it's really, companies have come back from summer breaks. It's September. Investors are back. They've accrued cash over the summer, and they're ready to go. They're looking to get stuff on their books now, lock in debt while they can, and companies are fully taking advantage of that.
There's also the buyer side of it, Ronan, as well. They want to lock in. You can get 4.89%,
yeah.
4.9%. So it's obviously the last hurrah at the bar there as well before these rate cuts actually start to get going. What about JP Morgan? What are they telling us in terms of the funding for M&A?
Yeah, it's interesting. We've seen a bit of M&A funding. Over here, we've had SES, which is acquiring Intelsat to try and compete with Elon Musk's Starlink. They did hybrid bonds to, I think it was about $1 billion hybrid bonds to fund that M&A, replacing some of its loans outstanding. But we have started to see kind of M&A trickle back in. I know it's one of the big things that, especially in the loan market, the bank loan market over here, people have really been waiting for that.
Okay, Ronan, thank you so much. Ronan Martin there on the very latest on the credit markets. Coming up in the show with Danny and myself, we're counting down to this jobs report. We're down to rounding up or rounding down. We'll give you all the Fed speak in just a moment. Good morning from New York.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
It's your Bloomberg Brief on this jobs day. Danny Berger and Manus Cranny in New York. Let's get you set up for the trading day. It is the main event. It is game day. We're going to have your August job 45 a.m. Eastern. And the thing that has been billed by some is more important than the jobs report is Fed Governor Christopher Waller at 11 a.m. Because, Manus, maybe the data doesn't matter. It's the reaction by the Fed to the data.
Absolutely, and what kind of guidance we get from them. Just thinking about the Fed speak overnight, we've touched on this a couple of times. From Mary Daly, it's about a downward descent. From Goolsbee, it's about the potential for multiple cuts over the next year. And we both just sort of sat down and said this in the break, which is the risk in this market, we're primed for pessimism. What's the risk of actually a good jobs number? I mean, you look at that bond market, it is like, it's like on a rubber band. And if you get a good jobs number, those rates, which have collapsed by 60 basis points in the past month, could certainly ratchet higher.
Yeah, to be fair, it's both negative equities this week, not to the same extent as the rally in the bond market. But bonds, the 2-year yield is currently at its lowest level in 2 years. The 10-year yield is at its lowest level since June 2023, despite what we could say is mixed data. You had strong ISM services yesterday. You had jobless claims that were better than expected. Well, they were lower, but in the good way. And still we're pricing in about 43% odds that they go 50 basis points next meeting.
Look, it certainly feels that we're at some kind of precarious point of where we're primed for a tough set of data. That can put 50 basis points in play. That's what the bond market has got. We're at an inflection point. That's what Citi, the conversation we just had there now, we're at an inflection point in terms of the jobs market, in terms of the rates market, and don't get all hung up on a disinversion in your yield curve. That was certainly the message, wasn't it?
The whole thing from Andrew Hollenhorst is it's about the trend. Even if you get something like 4.2% on your unemployment rate, the trend is still the same, and it is one that is growing. And it's what we heard from Goolsbee yesterday. The trend is concerning. It's not one piece of data that changes my mind.
It is about the fear of losing your job. That is what you're going to find out in these jobs numbers. If they're not firing people, and that's not accelerating, the fear is less. Surveillance to take you through the numbers.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
The unemployment rate moves up again. If you get a significant rise there, I think that's going to be a pretty worrying signal.
We're looking for north of 200K. Very importantly, a decline in the unemployment rate.
If we see a number closer to 100,000 this month, then we'll have to reassess our sort of view on the labor market.
It would take, we think, a pretty significant downside surprise to drive markets much lower.
There's no magic number here. It really is about the direction. And we should expect to see more softening in the labor market.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend. Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now on a 3-day slide on the S&P 500, set to become day 4, for now at least. Equity futures negative by 0.6% on the S&P, down by 1 full percentage point on the NASDAQ 100, going into the most important jobs report since the last one and probably until the next one. The estimates, the guesses, look a little something like this. The median in our survey, 165,000. Looking for the unemployment rate to drop back from 4.3 to 4.2. It is not if they cut interest rates this month. Bramo, it's by how much?
And this ultimately will be the deciding factor between 25 or 50, which is why I would argue, actually, this is an even more important payrolls report than just simply since the last time and until the next time. It will basically confirm the weakness that we saw in the July jobs print, or it will reject it and say it was seasonal, it was weather related. My question is, how asymmetrically are markets positioned to a downside surprise, and how much can you see some sort of bounce in yields if you do get the kind of upside 200,000 response that we're expecting from the likes of Bank of America?
There is a really strong bias right now to buy this bond market. We've had a 20 basis point move on a 2-year and a 10-year on the week so far. We're down another 3 this morning on 2s, on 10s, down a similar amount. This from SocGen. It's difficult to fade this move. Here's the line from them. Bonds are more likely to overreact to economic weakness than vice versa. I think that speaks to the bias at the moment.
Which is the reason why even the ADP report yesterday suddenly got more potential attention. If you take a look at the flows, and Bank of America puts this out along with EPFR data, it shows that in general, it is bonds that are getting the inflows, and it is stocks that are seeing some of their first outflows in the United States going back a couple of months since June. So this really is the bias right now at a time when people are reassessing a neutral rate somewhere below 3% for the first time that I've heard that in years.
Just to pick up on things in that FX note from Bank of America, here comes 50 basis points. That's what foreign exchange is screaming right now. Dollar yen down for a 4th consecutive session, 4 days of yen strength, 4 days of dollar weakness. This market, according to B of A, the FX market screaming, here comes 50.
Yes, Jonathan, FX market screaming, here comes 50. You started the show, though, with the exact point. It doesn't matter what we get. We know the Fed is cutting. The debate is 25 or 50. Yesterday, though, Austin Goolsbee overnight, the long arc shows inflation coming down. They're seeing this weakness in the labor market, but he said it's not just about this point. It's not just about potential this cut. It's the path. So after we get this cut in September, what does it look like for the rest of the year?
The conversation we're having around the table with market participants about what happens and what may not happen on September 18th still sounds very different to what we hear from Fed officials. We're talking about the difference between 25 and 50, and even some of the most dovish members of the FOMC aren't talking about 50. They're talking about perhaps a string of rate reductions over the next year.
Yeah, they're just basically avoiding it. Let's be clear. I mean, even Mary Daly, when asked specifically, is it 25 or 50, said, we'll have to see what the data says. None of them want to commit. They want to point to the destination, which raises the question of the destination, which no one knows anything about because we don't know what the neutral rate is. And ultimately, that's what I thought was most interesting about Austin Goolsbee. It is this sense that we have a long way to go. Then you hear from John Paulson, 2.5%. You hear from others, maybe it's closer to 3%, but nonetheless, suddenly we are talking about a neutral rate that A, no one knows anything about, that B, at one point was thought, maybe is this what we're seeing right now, and C, is suddenly seen as something even closer to zero, as we heard from Ed Al-Husseini talking about where the destination could be. That is where we need to focus. That is where we're getting no clarity from Fed officials, and that is what I'm guessing Chris Waller will not address today at 11 a.m.
If you're exhausted by all of this, the good news is that the quiet period starts tomorrow, and then the Fed speakers can't speak anymore until the Fed decision on September 18th. Lisa mentioned the Fed speak. Let's go through the times. 8:45 Eastern Time. The New York Fed President John Williams is giving keynote remarks. We'll see if anything out of that actually speaks to the jobs number we had 15 minutes before it. And Lisa mentioned Governor Waller, 11 a.m. Eastern Time. That's going to be a big one to watch. The last big Fed governor set to speak before the quiet period kicks in a little bit later tomorrow. So that's how we're set up for the day ahead, the morning ahead. This is the price action. If you are just joining us, welcome to the program. Equity futures pulling back, weaker on the S&P 500. Stocks are lower, bonds are being bought. We've seen that all week as we've kicked off September. Yields are lower by 3 basis points. The 10-year 3.6967. In foreign exchange, another day of yen strength. For the euro, at least, things a little calmer, unchanged. Euro dollar 111.11. Coming up this hour, we'll catch up with Jay Poloski of TPW with stocks falling ahead of the payrolls report. Tobin Marcus of Wolf Research as Trump pledges to cut the corporate tax rate. And Sarah House of Wells Fargo on what it would take for the Fed to go 50 at the upcoming meeting. Let's begin then with our top story. Stocks falling ahead of the August payrolls report at 8:30 Eastern Time. Traders looking for evidence that the Fed has stuck the soft landing. Jay Poloski of TPW Advisory taking an optimistic view on the economy, writing, we read the U.S. jobs market as solid, the consumer is healthy, and credit markets as open and robust. Jay's with us around the table. Jay, good morning to you, sir.
Good morning.
What are you looking for at 8:30?
You know what? It's interesting, right? Because everyone wants to zoom in. What's the number going to be, right? We want to do the opposite. We want to zoom out, right? Because it's a number, and we're going to deal with it, and it's going to be what it is. More importantly, we want to think about the bigger picture. And the bigger picture is the global economy is fine. The U.S. economy is fine. Credit markets are wide open. Issuance is huge. Real incomes are growing, not just in the U.S., but in Europe and in Asia as well. You have global liquidity on a very nice uptrend. The Fed is going to reinforce that. Whether it's 25 or 50 is less important than we are in a global rate cutting cycle that is probably going to be the most synchronized in the last 40 years. Global liquidity, supportive. The public-private partnership investment spending for AI, for climate, and for conflict is robust, open, and going to support the global economy for the next couple of years. And I think we're going to have political continuity in the United States. I think Vice President Harris is going to win. I think she's going to win in a landslide. I think the opportunity for a Democratic sweep is growing, and that supports. And I know there's some grins around the table. No one's showing it.
There's no grins here.
That's fine.
Didn't happen if it's not on camera, Jeff.
That's fine. But what it does is it ensures policy continuity in the U.S., which has led the U.S. to be by far the best performing developed economy in the world since the pre-COVID period. All this sums up to be supportive for earnings, and earnings are the linchpin for stocks. And not just Q2 better than expected, but the 12-month forward earnings outlook continues to rise, and it rises in the U.S., it rises in Europe, and it rises in the Asia Pacific. And when you have that situation, then you want to be supportive. You want to be focused on the opportunity set, not looking for a big drop. Stocks are not going to drop in a big way when earnings expectations are going up, full stop. So we want to stick to the process, and we want to focus on rotation, not recession.
Okay, I started smiling on the 8th reason to be bullish. Elisa's going to give you every
I only gave 4. I don't know. How did you, I guess I gave it very convincingly because it's out of my gate. Okay,
can we sit on capital allocation just a little bit longer?
Sure.
When you say rotation, what are you thinking of? The rest of the world, small caps,
yeah,
the cyclicals? What are you looking
point,
at?
John. Look, August was the 4th month in a row where the S&P went out at an all-time monthly high. The 4th month in a row, right? August was also when 47% of equity markets, okay, global equities, hit new 52-week highs, the best number in over 3 years. So yes, you had the RSP, the equal strength S&P ETF, hit a new all-time high. So you have the cyclicals breaking out. So I think the opportunity set continues to just be very robust, and the fact that we're able to be where we are in the equity market with tech taking a pretty big header, we're effectively passing off leadership from tech to the cyclical space, from large cap to small cap. And with the dollar, which you pointed out is a very important point, and we've been focused on this for a while, and it's been a long time in coming, we think the dollar is rolling over, and that's going to support non-U.S. equity outperformance.
The reason why I was smiling is because the market disagrees with you on several different points. There is a concern about weakness, and if you take a look particularly at the commodity markets, you see oil prices at the lowest level in more than a year, and you have the OPEC plus countries really responding to this. How do you understand where you differ from the market and where the market could have sort of their hands around something that you want to pay attention to?
Well, Lisa, I've been around long enough to know when the market disagrees with me, that's not necessarily a bad thing. You know, if you can stick with the process, if you can zoom out rather than zoom in, that's where you want to be. And your point on commodities is absolutely right. That is the kind of the thing that's not quite working out from my view, and it worries me because we're long commodities. We're overweight commodities and underweight bonds, and we have been that way all year. And we go back to the global economy, which we think looks robust. We think we're early cycle, not late. We think inflation is behaving better than expected. The rate cut cycle is going to be supportive for the economies. That commodities probably don't have a lot of downside here, and the upside we think is relatively significant. And so, you know, we're long oil, we're long copper. We're long a couple of other things as well, gold miners, uranium miners, and right now they're all sitting on pretty powerful support levels, and they've come in a lot. So copper's down 20%, uranium's down more than that, oil is down significantly, as you said. So it's kind of it's a little bit, that's where, you know, and the picture is never perfect, right? The picture is never perfect. And so you always have a fly in the ointment, and right now, for our point of view, the fly in the ointment you identified correctly. It's commodities, and we're watching it very carefully.
In 2 hours and 20 minutes, we get what some people expect to be another fly in the ointment, which is a payrolls report that could potentially confirm the weakness that we saw in the July payrolls report. What would we have to see? What would we have to get for you to reassess the bigger picture view and wonder whether maybe some things were fraying just a bit more around the edges?
Yeah, as I said, we want to zoom out, not in. We try not to pay too much attention to any one number. It's a bigger mosaic than that. You have one little tile over here that's not perfectly set. That's going to be a little bit of a bummer, but you can fix that. When we look at the jobs market, the thing that we hang our hat on is that right now the percentage of job openings to people looking for work is roughly 1 to 1. People talk about it being like the lowest it's been in years. The other side of that coin is that it's better than it was for the entire period from 2000 to 2018. So the job market is just simply normalizing. It's not falling off a cliff. And when companies can issue bonds, as they have this week, right? This week has been a monster week for investment grade issuance. When rates are coming down, when credit is becoming more available, not less, we're not really concerned that the economy is all of a sudden going to fall off a cliff and people are going to have to lay off tons of workers. It just doesn't, we really don't see an environment where the economy is going to fall off the cliff. People talk about the consumer. Disposable income to interest obligations is at the best it's been in 40 years. There's no real pressure on the consumer. The consumer is fine. People talk about it like it's a problem. It's not a problem. It's fine. And companies are flush. And the government, which is really who's holding the bag these days in terms of fiscal expansion and big deficits, they are issuing plenty of debt, and everybody's happy to take it to the point we've been talking about.
Jay, let's talk about the government. I was one of those grinning because we're clearly looking at
everybody was grinning. I was happy to see that.
But you have such conviction about the election, even though it is, if you look at all the polls and crosstabs, it is a knife's edge. And Pennsylvania right now is what Josh Shapiro told me, a statistical tie. But given that said, if it's not a landslide, how do you see that, what you call public-private partnership? How does that change under a Trump administration?
Well, I think it's pretty clear, right? It's not just our point of view at TPW Advisory. It's the view of Goldman Sachs. It's the view of Moody's. It's the view of the Peterson Institute. It's the view of basically anyone who's looked at the two policy mixes of the two
I thought we wanted to go against the establishment here, Jay. Then you just started listing a lot of establishment organisations very quickly.
Well, when it works for you, you take it. I mean, come on, yeah, exactly. We go back to the big picture. But look,
Goldman Sachs agrees with me.
Yeah, I mean, hey, I'm a Morgan Stanley guy. And I don't, typically I'm not really all that excited about Goldman agreeing with me. But in this case, since I'm under assault here from all sides, I'm pulling out every stop. But look, again, the U.S. has been by far the best performing developed economy coming out of COVID. Best growth, best inflation. That's the Biden-Harris policy mix. The sustainability of that, I think, is really critical to being positive about the U.S. over the next 4 years, right? We've had a view, global macro, blue sky outlook, 2023 to 2027. That's our focus. Policy continuity in the U.S. is pretty important to that. The Trump agenda is an agenda where you're going to deport millions of people. What does that do? That just throws the job market into utter chaos. You're going to extend tax cuts. You're going to blow out the deficit. What does that do? That's really great for the dollar. You're going to institute massive tariffs on pretty much everything. What's that going to do? That's going to spike inflation. So as I look at it, you're talking about an imploding job market. You're talking about spiking inflation. You're talking about a blowout deficit. You're talking about tanking the dollar. So to me, I am a dollar bear. So I kind of like the Trump policy mix from that perspective because it is anti-dollar for sure. But on the other hand, we'll trade off that dollar smash for policy continuity because I think the dollar is rolling over anyway as the interest rate differential shrinks.
Jay, got to leave it there. It's good to see you.
Very much happy to be here.
I know it felt like 3 against 1, but that's not what it was. Jay Pulaski of TPW. Jay, thank you, sir. Yeah. Let's get you an update on stories elsewhere this morning, looking ahead to payrolls with some news and your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. 7&I says it is informing Couche-Tard that the Canadian company's buyout offer is insufficient. The Japanese operator of 7-Eleven stores revealed for the first time the offer price, $14.86 a share, or that's a market value of almost $39 billion. It's a 21% premium to when the proposal was first disclosed, but it is below February's one-year peak in share prices. PwC has resigned as auditor for Country Garden. The defaulted Chinese developer says PwC is unable to fulfill the timetable requirements to publish its overdue financial statements for 2023. A filing shows it will be replaced by Hong Kong-based Zhonghui Onda. A source told Bloomberg last month that PwC was facing a 6-month ban, part of a punishment over its role in auditing another failed developer, China Evergrande. Broadcom shares lower in the pre-market trade, 8.7%. It disappointed on its sales forecast, highlighting non-AI operations that are growing more slowly than anticipated. The company does have a wide variety of offerings, including mainframe products, security and data center software. It's also among the main chip suppliers for Apple and other big tech companies. And that's your brief, John.
Danny, thank you. More from Danny in 30 minutes' time. Up next on the program, competing tax policies.
To further support the revival of American manufacturing, my plan calls for a reduction in the corporate tax rate from 21% to 15% solely for companies that make their product in America.
We'll talk about how workable that plan actually is on this Payrolls Friday this morning. Good morning.
On the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley.
It's Jobs Day, and Bloomberg has the report under surveillance.
It's from super hot to solid.
This is normal.
I think people underestimate the behavioral aspects when it comes to the labor market.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
So what is bad on September 6th?
Nobody really has a full answer on it.
I don't know what counts as good news these days.
It's a big debate.
The August Jobs Report, today on Bloomberg.
It is Jobs Day and your equity market is sliding. We're down by 0.6% on the S&P 500, just a little bit softer on the session going into that jobs number. Under surveillance this morning, competing tax policies.
To further support the revival of American manufacturing, my plan calls for expanded R&D tax credits, 100% bonus depreciation, expensing for new manufacturing investments, and a reduction in the corporate tax rate from 21% to 15% solely for companies that make their product in America.
So here's the latest. Donald Trump pledging to slash the corporate tax rate in an effort to fuel the US economy. His plans directly contradicting the proposal from Vice President Kamala Harris that would raise rates to 28%. Tobin Marcus of Wolf Research writing the following: only in the unlikely event of a Democratic trifecta do we expect market-wide earnings headwinds from corporate rate hikes, along with modest new tax benefits for families and housing. Tobin joins us now for more. Tobin, I just want to park the compare and contrast. I just want to focus on that conditional corporate tax cut from Donald Trump. How workable might that be?
I think there are pretty serious questions about exactly how to draw those lines. Certainly, it is deeply unclear from the way that he characterized it yesterday exactly how it's supposed to work. I think tax experts around DC are a little bit unclear on exactly what's meant by this. And frankly, all of this stuff, of course, gets fed into the congressional meat grinder. If and when he wins the election and has a chance to try and get this done, then there will be a process of trying to flesh this out. And it's not totally obvious how much support there will be, or again, how much implementation possibility there is around sort of conditioning that corporate rate cut on U.S. manufacturing.
Tobin, what I hear from a lot of people is that this is the opening salvo that Trump is talking about before negotiation. Is it your expectation he's coming in very low and then potentially it'll level out somewhere in the 20% range?
Yeah, I think that both candidates are proposing more than they are ultimately going to be able to get done on taxes. And your colleagues at Bloomberg earlier this week tallied up everything that Trump and Vance have talked about from a tax and fiscal perspective and got a number north of $10 trillion. I think it's fairly clear that we're not going to get a $10 trillion tax package through Congress, even if there's a Republican trifecta. So there's definitely going to be a need for prioritization. And frankly, they're starting $4 trillion in a hole based on the need to extend the expiring portions of Trump's 2017 tax package that expire at the end of next year. The cost of just getting that done is going to be pretty serious at a time that our overall fiscal situation, of course, does not look especially good. The deficit outlook looks quite grim from here to the horizon. So, I think there's a lot of these proposals that are being thrown out there, whether it's cutting the corporate rate to 15 or no tax on tips or sort of this Social Security tax carve out. Not all of this is going to end up being doable.
Right, it's a grab bag, or what I call the Oprah election, on both sides when it comes to these. And to your point, it really depends on Congress. But you also write in your note that for Harris, it's really about personnel changes, significant personnel turnover, and potentially she's going to be more pragmatic. Who exactly do you think she would put in positions that potentially move her more to the center?
Well, look, I think it's too early to speculate about exactly who it is that's going to get what job. But certainly the indications that we've gotten from the way that she's been running her campaign, from the way that the DNC was pitched, from the sort of reports from people around Harris, are that we're probably going to get fairly establishment figures. I mean, that's what the campaign looks like. She's, I think, notably not under a lot of pressure from the left. Compared to where Biden was in 2020, when he had done these Biden-Sanders unity commissions to try to heal the wounds coming out of that fairly bitterly fought primary. And so the Biden administration, in many ways, has been a power-sharing arrangement, with progressives almost as a junior coalition partner. And Harris is not in that position. That dynamic will change after the election. Certainly, I don't think that the left wing of the Democratic Party is going to remain quiet indefinitely. Certainly, they'll come out and want their seat at the table. But she's not, heading into this election having made a bunch of promises about who gets what or how much power the progressive wing gets. And so I do think that she will have the latitude to put people around her that she has confidence in. And I think that generally that's going to be people who, she's putting in there to make good decisions, to trade off costs and benefits rather than, set of ideological commitments driving it.
Tobin, just quickly here, we've heard a number of banks, including JP Morgan and Goldman Sachs, talk about Donald Trump's plan as leading to a steeper deficit over the next decade. Do we know enough information, given all the holes, to even say who's going to create a bigger deficit?
So I think there definitely are questions about it. And looking at the stated plan and what that means for the deficit, I do think is at some level missing the point, because so much of what is being proposed is not actually going to get done. I think the risks of a high deficit are probably highest under Trump. There's more freedom of movement in a Trump win scenario because he is so much more likely to have unified Republican control of Congress. But you know, the bipartisan scenario under Harris, where she probably would be facing a Republican Senate, could very well be a high deficit scenario. You know, she has proposed to extend most of the expiring tax cuts, as Biden did. If that happens, I think it's probably not going to be paid for in substantial part because it's going to be really, really challenging to get bipartisan agreement on $3 trillion worth of offsets to cover the cost of that. So, you know, in a Harris scenario, we may well see just a large deficit finance partial tax extension, even if you don't get a lot of proactive new policymaking, no greenfield stuff.
Tobin, got to leave it there. Appreciate the update. Thank you, sir.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Three-day slide on the S&P 500 through yesterday into this morning. The slide continues. We're negative by 0.6% on the S&P 500. On the Nasdaq 100, down by more than 1%. We'll talk about the drag from Broadcom in just a moment. The small caps, the Russell, negative by 0.45. In the bond market, let's chop up the yield curve, the 2-year, 10-year, 30-year, and focus on 2s and 10s. We've had a move this week of 20 basis points on both the 2-year and the 10-year. The 2-year down to 371, on the 10-year down to 369. I mentioned Ian Liggett of BMO a little bit earlier this morning. I was talking to Lisa about him a few times. This is the survey they do. pre-NFP. In that survey, they said investors are anticipating lower yields and there is a bias towards buying any post-payrolls down trade. 47% of respondents anticipate that the next 15 basis points in 10-year yields, Lisa, will be lower.
And that's what you saw from other firms as well, who said that right now their clients are buying bonds with no questions asked, but they're looking at the data second. To me, the question is just how asymmetric is this sort of balance of risks? If you get some sort of downside surprise, buy bonds. If you get a massive upside surprise, the non-farm payrolls report, maybe sell around the margins, but then the buyers are going to swoop in because there is this belief this economy is materially slowing.
It feels like this is the trend, and it's going to take more than one jobs report to convince some people otherwise. Let's turn the page and get to a different story in foreign exchange. Dollar yen. Dollar yen at 142.90. We're negative by 0.4%. More yen strength. I mentioned this note as well from Bank of America. The FX market screaming the Fed is going 50.
And this, it's not just the Fed going 50. It's also this idea of the Japanese authorities that are expected to hike yet again later this year. At this point, though, a lot of people saying because of all the noise elsewhere, the biggest litmus test for what the currency read-through of the non-farm payrolls will be the yen. That's what people are looking at. Mark McCormick coming up is basically saying it's almost the highest conviction trade at this point because of both sides of the trade, whereas the other sides get a little bit more fuzzy in terms of the direction of travel for those central banks.
Good evening, Tokyo. 142.90 on dollar yen. Under surveillance this morning, some top stories for you. Here's Broadcom delivering a disappointing sales forecast. The company expecting sales to come in at roughly $14 billion in the fiscal fourth quarter, suggesting its non-AI operations are growing more slowly than anticipated. Lisa, that name is down by almost 9% in early trading.
Was it really that bad? That's what I'm wondering. If you take a look at the data, it wasn't terrible. What it did suggest is that non-AI types of applications saw a little bit of a decline. I'm more interested in what the read-through is to Apple, because that is their North American customer that they refer to obliquely on a lot of their calls. They're such a big supplier. Does this indicate a little bit more weakness in some of the smartphone development? That might be the more interesting angle here.
They also still beat expectations, and the market is reading into the part of Broadcom that's not really attached to AI. Morgan Stanley, after the report, saying AI growth is, quote, not linear, but remains strong. If everyone is in this bonanza about AI, and that's still a part of their business that's growing, it does feel like what you say. It wasn't that bad.
Big week for the smartphone business next week. Apple with a big unveil on Monday. Huawei with a big unveil on Tuesday. We'll have some guests for you on that to kick off next week. I want to talk about the Fed speak briefly. San Francisco Fed President Mary Daly telling the Wall Street Journal any further slowing in the labor market, quote, would be unwelcomed. Chicago Fed President Austin Goolsbee also speaking, telling Market Watch he's seen mounting warning signs from the labor market and expects, Lisa, multiple rate cuts over the next year.
And that's the key. This isn't just about 25 or 50. You were mentioning this before. This, to me, is really an interesting quote. I want to read it verbatim. The long arc shows inflation is coming down very significantly, and the unemployment rate is rising faster than Fed officials had expected in June. There is a feeling that things are moving more quickly, and that maybe, even though everyone says again and again, Fed officials do not see anything that we do not see, maybe they are seeing something that we do not see. And you could feel that in the tenor of the beige book and some of the motley picture behind some of these data points, as well as particularly from the Chicago region that Austin Goolsbee oversees.
Look out for Williams and look out for Waller a little bit later this morning following that jobs report at 8:30 Eastern time. Let's talk about the latest in the steel industry. The Cleveland Cliffs CEO, Lorenzo Goncalves, saying he would bid on U.S. Steel's assets if Nippon Steel's $14 billion takeover bid fell through, adding that he's working with JP Morgan and Wells Fargo on a plan. His comments coming a day after President Biden was said to be preparing to block the Nippon Steel deal. AMH, the saga continues.
Yeah, and it's welcoming for this CEO who's been one of the individuals at the table trying to bid for this. He says, I will not deploy the details of the package in this interview, but we are good to go, good for the money. 2 questions. What is the money? Because they came in under Nippon Steel's bid. And 2, if this was to go through, where's the FTC when it comes to then the steel industry in the United States? Because this would be a massive and really the only big player.
All I can say is I just don't have a lot of clarity on what actually is going on. There are questions around, I mean...
You're not alone.
I mean, the idea of questions about how they're sweetening the deal for the unions, the questions around the fact that Nippon Steel came out and said that they had not been informed, that Biden was planning to block it, the idea that you have suddenly, Cleveland Cliffs coming in saying, hey guys, here we are, we're still available for you. All these things, you don't get a sense of some sort of controlled process and how much of this is a negotiating tactic and how much of this is actually real.
It's certainly a big feature of the campaign trail, that's for sure, and will continue to be, I have no doubt. Let's turn to foreign exchange. Mark McCormick of TD Securities, looking abroad to see how the US stacks up to the rest of the world, writing non-US growth is indeed slowing, led by an ongoing China slump. Global manufacturing PMIs continue to slide, geopolitical risks are on the rise again, and the fall brings tons of event risk that should reinforce higher volatility and sluggish carry returns. Mark is back with us for more. Mark, welcome back to the program. Let's go with this quote. I think it's really important. We've talked a lot on this program about normalizing interest rates here stateside. Haven't talked nearly enough about rebalancing growth differentials. How difficult would that be given the struggles that we see in Europe, the struggles we see in China?
Well, I think that's where all the asymmetries basically lies, because essentially what markets have been doing is been looking only at the U.S. data, U.S. surprises, U.S. growth revisions, and the Fed. And basically what they're saying is U.S. is slowing, the Fed's going to deliver some cuts, inflation's moving in the right direction. We don't really care about inflation more. All we care about is labor market and growth. And what they're kind of missing is that China, all the leading indicators we track are at a much lower level than the U.S. And the rate of change on where all those indicators are in Europe are actually moving further and faster in the wrong direction relative to the U.S. So when you stack it all up, a big piece you have to think about is, again, FX is a relative market, but it's only focused on one absolute theme, which is the U.S. So I do think that we're going to broaden the understanding out. It's like we're at September. We know the Fed's going to cut, whether it's 25 or 50. I don't know if it's going to have a tremendous impact in the months ahead, but what matters is what's happening outside the U.S., particularly as we get through the election, and what those consequences are for some of these other countries.
So let's get to the trade. Mark, are you saying there's limits to the downturn in the US dollar, or are you saying that this can flip in the other direction? It's time to get long?
Well, we're absolutely, we're long the dollar. We have three views. We like euro lower, we like Kiwi lower, we also like Singapore dollar lower. So those are three ways of kind of thinking through it. I think, as you mentioned, you were talking about the asymmetries. I think it works this way. One, we're well above consensus. TD is basically at 205 today, so we're looking for a pretty strong rebound. I think the asymmetries is what we tend to do is, if you look at the factors that are driving the FX market based on the portfolios we run, this is all about mean reversion. There's really no macro story, inflation, growth. Those indicators aren't really driving performance in FX the way we think they are, at least based on narratives. And it's positioning and short-term valuations that are really dominating FX performance this year. And what we've finally seen is those indicators have flipped in favor of the dollar. So I think once you start seeing the market positioning and biases leaning in one way, if you get surprised, then you start to see the market move the other way very quickly. So I think that's the pain trade here, is that the dollar could rally quite aggressively on the number we're looking for, versus, say, if data comes in weaker than expected. I don't know how much more downside there is. Obviously, the knee jerk will be important, but I don't think there's a lot of follow-through.
Let's look at some of the assumptions that are underpinning the market positioning that you're talking about. We were talking earlier about just how much the Fed can cut rates, and the idea that the FX market is essentially pricing in a 50 basis point rate cut this month. There's also this belief that the Federal Reserve is likely to cut more aggressively than the ECB. This comes even as we saw wage inflation come in lower than expected today in the Euro region. Growth actually downgraded in the latest reading. At what point do you think that is poised to flip, with people looking for at least the same number of rate cuts at the ECB, if not more?
It's an important point. I think what's happening is the market's trying to figure out what the neutral rate is in the U.S. Fed's discussed it. There's a short-term rate. There's a longer-term rate. And if you look at market pricing on the Fed, essentially neutral rate has gone like very, very low. Just think of the assumptions around how do you get to a 3% terminal rate? 2% inflation, 1.5% growth. Those are basic assumptions that even if you have 2.5% and 1.5% growth, just in terms of inflation and growth, you're still somewhere 3 to 4% in terms of a neutral rate. So market, like basically taking Fed pricing to and below 3%, is indicating that there's a recession. And it's not the same read that you're getting from the equity markets. So I do think that there's a massive disconnect, that if the U.S. data, which again is starting to stabilize and moving in a better direction on the whole, and we're actually starting to see these indicators move in a worse direction in the Eurozone, I think that the line of direction here is that if things get worse in the US, they're likely to get worse in Europe. And I think if things are going to get worse in Europe, the thing that's really connected is China. China and European data are linked at the hip. So what you're starting to see, if China is a leading indicator, it's one that's telling you that things are not going to get better in Europe. They're likely to get worse. And if you think about the what we have to see come from France is they will deliver a budget. We've also seen the German elections. I think there's also a feedback loop here where the politics can reinforce waning confidence in the European growth story. So to me, we're probably at peak divergence between the ECB and the Fed. And that, again, the asymmetries basically see that the rate differentials move in favor of the U.S. And also keep in mind that the relative equity story is I don't think Europe looks very attractive relative to the U.S. on equity performance.
I don't want to go into the neutral rate right now because I get very passionate, Mark. I really feel like this is the key question right now as everyone tries to game out exactly where that neutral rate is. You talked about peak divergence between the ECB and the United States, the Federal Reserve. Do you think that we're seeing peak divergence right now between the Federal Reserve and the Bank of Japan at a time where this basically is the consensus trade increasingly that the Bank of Japan is going to hike rates again and that potentially that could continue giving that strength that we're seeing in the yen?
I think it's amazing how quickly consensus can flip because the expectations is the BOJ was not going to be able to do anything this year. Again, we've been on the side that they have to move. We're looking for the July hike and we are looking for more hikes again. I think, again, a big piece of this is we kind of discussed is there's Japan Inc. It's, again, the government, the pension funds, and the BOJ are all working to strengthen the yen, reduce the undervaluations, and, again, trying to find a way to bring some of that money back home. There was a great Bloomberg article that went through the GPIF and the expectations of people who cover the GPIF and where the money's going. And essentially on the equity and on the fixed income side, they're bringing more money home. So, they continue to raise rates. That gives the GPIF an incentive to repatriate foreign invested bonds back home. And so that is further cushion to strengthen the yen. So I think the key themes, the highest conviction trades we have is we're going to get more macro volatility. That continues to undermine the carry trade. That's bullish for the yen. And the yen should continue to outperform G10 crosses. And if we get more volatility and the U.S. election is a big driver, again, I think the market's completely ignored what is basically a toss-up at this point. If you think about, again, Trump's platform of deregulation, tariffs, and tax cuts, that's good for U.S. equities. That's bad for rest of the world growth. That's more defensive positioning. So for us, it's higher vol, reduced carry, strong yen, and a defensive market that reinforces the dollar.
Mark, why hasn't the market priced in election risk?
I think there's a lot of fatigue around how to trade it. Everyone's wanted, like, right out of the year, there's a lot of interest in, like, what should we do? How do we hedge? Dollar CNH should be higher. I think it's just there's been so much uncertainty and it doesn't stick as a trading theme. And, people were able to sink their teeth into the U.S. story, the Fed story, the data story. Again, as we've talked about in our research, we use the term serial monogamous, that at least for the FX market, it can only focus on one thing at a time. And then when it gets distracted, it finds a new theme and it kind of sticks with that until that doesn't work. So I think the U.S. election just hasn't had the sticking power because, again, there's no conviction. It's, again, even when it was very clear that Trump was going to beat Biden, at least based on the polling data, we started to see the emergence of trades that would resemble a Trump victory. U.S. MSCI outperforming China, some strength in the dollar. That all just went away. And I think we are now kind of back to having to focus on this. We've got the debate next week. And I think when we roll in through September and October, the market no longer can avoid this theme. And we'll be past the Fed. They will have potentially cut in September, and we can focus on a new thing. And that thing's going to be probably the French budget, the U.S. elections, and some of the lingering geopolitical risk. Because one of the things that's really important, what we've seen is our geopolitical risk index is now at a much higher level than what we see on our macro volatility index, which to me suggests that the markets there's some discontinuities there.
Stacked 2 months ahead. Mark, thank you, sir. Mark McCormick there of TD. If you are just joining us, welcome to the programme. Payroll's out a little bit later this morning, 8:30 Eastern Time. The estimate in our survey, 165,000 for the unemployment rate, looking for that to drop from 4.3 to 4.2. The number's just around the corner. Let's take the opportunity to get you up to speed on some stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Biden's son, Hunter Biden, is avoiding another trial. He pled guilty yesterday to federal tax charges after his gun case conviction just months ago. low. The tax charges carry up to 17 years behind bars, but federal sentencing guidelines should mean much less time. He will be sentenced in December. Apple has approved an update for Tencent's WeChat just in time for the iPhone 16 release. The latest version adds new features that include the Instagram-like WeChat moments and live streaming, that according to unnamed sources. There had been speculation in China that a dispute between Apple and Tencent over App Store fees would snowball into something larger, but this app approval helps put an end to that speculation. Super Typhoon Yagi came ashore Hainan Island in southern China with destructive winds and torrential rain. The Joint Typhoon Warning Center said Yagi had maximum sustained winds of 150 miles per hour. That storm is equivalent to a Category 4 hurricane, which is considered a major storm. The typhoon is expected to cross Hainan's west coast today. That's your Bloomberg Brief. John.
Danny, thank you. We'll touch base with Danny again in 30 minutes. Up next on the program, Catalyst for a cut.
I don't necessarily think that we have to have a payroll report that is as strong potentially as 100K to have 50 basis points. I think the 50 basis point rate cut is really going to be dependent on an environment that is much weaker than what we're seeing right now.
I love the framing of that. 100K is still strong. Greg Dacko. Just how low is the bar? That conversation up next.
Artificial intelligence. Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
Earnings. I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Stocks down once again. 3-day slide could become day 4 on the S&P 500, down by 0.6%. Yields lower by another 3 basis points on a 10-year, 369.48. Under surveillance this morning, Catalyst for a cut.
I don't necessarily think that we have to have a payroll report that is as strong potentially as 100K to have 50 basis points. I think the 50 basis point rate cut is really going to be dependent on an environment that is much weaker than what we're seeing right now. The Fed does not want to be appearing as recalibrating monetary policy rapidly in an environment where the economy is still relatively strong.
So here's the latest. This is the setup. We're less than 2 hours away from critical jobs data. Bloomberg survey is expecting 165,000 jobs added for August, marking a stabilization in the labor market. Sarah House with Wells Fargo saying the employment situation for August will be imperative in determining if the rapid deterioration in employment conditions indicated by last month's report was merely noise or a signal that the jobs market is struggling to maintain traction. Sarah's with us for more. Sarah, welcome back. Let's go there. The distinction between the two. What are you looking for this morning that confirms it's one and not the other?
Yeah, so I think it's really a matter of momentum. So to what extent do we get perhaps a bounce back in hiring, which we in the consensus expect? To what extent do we get a possible dip back in the unemployment rate versus do you actually see the actually worsening? So seeing the unemployment rate increase and potentially a further downshift in the hiring numbers.
Sarah, looking at some of the guesses today, at the upper end, when I double click into the research and get the explanation for why people are looking for 200K, there's a buzzword on Wall Street this week. It's payback. I keep seeing this word payback and then I read the word weather. Sarah, what was it about July that might have been impacted by the weather and how much payback do you expect to see in this report?
Yeah, so I think there are some expectations that given you had Hurricane Beryl hit during the survey week, that was depressing payrolls, that maybe you saw some misclassification of workers who were not at work due to weather misclassified as temporary layoffs, which is why you saw that increase in the unemployment rate. I'm not buying the weather story so much when you look at the industries that would stand to be most impacted by that landfall of the hurricane, like construction, manufacturing, so those with weekly pay periods. Those actually improved over the month. We didn't see a big impact in terms of the response rate. And when you look at some of the state data, yes, you saw a big drop back in Texas, but you also saw 22 other states see payrolls decline. So it looks more widespread than that. So we're not expecting that much payback. I think some of the pickup we're expecting just has to do more with just some of the volatility that's inherent in the payroll survey.
Let's say you're correct, bang on the nose, and it's 145,000 that we get at 8:30 a.m. Eastern. How much are we really looking at something more like 85,000 when you downgrade it for the revisions that we can expect in, say, 6 months' time?
Yeah, so that's the tough part. So obviously we saw the big benchmark revisions since the last jobs report that suggests that those initial prints have been overstated. So we think this has a lot to do with the birth-death model. So the fact that we're still seeing more jobs added to because of business formation, which we've seen in the more recent data has really gone back to its pre-COVID trend. So while we didn't learn anything explicitly about the extent to which payrolls might still be overstated since last March, that I think there is still some skepticism that whether it's some of the monthly revisions or some of these benchmark revisions, that the underlying trend in hiring isn't quite so strong as first meets the eye, which I think will make the unemployment rate even more important than it usually is, as there has been, I think, some skepticism over the veracity of the payroll numbers.
There's also this belief that maybe there's something going on that is more pernicious, and that we've seen this in history, that it never looks like a serious downturn until it's too obvious and too late to really get in the way. Where are there those signs this time around? Because we've talked to different retail executives, we've talked to analysts who say things are softening, but they really look more like they're normalizing. Can you point to anything that contradicts that and edifies what the market is expecting?
Well, I think it's more, again, going back to just this momentum story. So when we look at just the level of various labor market indicators, they're not bad in and of themselves, but it's that shift in direction that I think is where concern creeps in for me. I think if I want to look at some of the more worrying signs, I'd look at the gross hiring rate. So yes, we saw an uptick here in the July numbers, but still some of the lowest levels we've seen since 2014, which means that if we do get any pickup in layoffs, you're going to see a sharp slowdown in net hiring. So the layoff numbers, I think, are still one of the brightest spots in the jobs market, but that lower hiring rate, the fact that you continue to see the trend lower in terms of business hiring plans, whether it's the job openings, the small business numbers, you have the PMI, the employment PMIs, whether it's the ISM or the regional Fed surveys, are some of the weakest we've seen since coming out of the recession. I think all of those are still telling us that we're in a very delicate position with the jobs market, where that normalization could quickly turn into outright deterioration.
Sarah, when you say you're focused on the unemployment rate, the jobless rate barely rounded up last month. It actually was 4.253%. How important to you are those 3 decimals?
Yeah, so we've seen actually it's the past couple months that it's barely rounded up. So we've been expecting some give back in the unemployment rate in previous reports, and yet it just keeps creeping higher. So I think we have to be careful in terms of even just looking at it out to 2 decimals and really going back to the trend. So even if we get a dip back here in August, you're still going to see the unemployment rate up 0.5 percentage point from where it was a year ago. So that would signal that maybe momentum isn't weakening quite as much as what the July report signaled, but this is a jobs market that is still softening. We are back to, I think, what is a more idealized state, but if you start to see further weakening, it gets really uncomfortable, and I think potentially sets off that negative feedback loop where you get that pullback in income and spending and therefore hiring.
Sarah, got to leave it there. Sarah House of Wells Fargo looking for 145 in the jobs number at 8:30 Eastern Time. You can really sense the anxiety, can't you, from a lot of people looking at this market this morning. I've heard it all week around the job story, just how finely balanced things are. That if we get a really soft print, it's a string of 50s. We said this yesterday, you get a really strong print, you have to unwind some of the move we've seen in the last few weeks.
There's this feeling that we're really at a tipping point, that at this point you could see a real dramatic deterioration, or you could see a firming up and then even a recovery from some of the slowdown that we've seen. And it seems like almost the Fed is going to make the difference, even though we don't understand the transmission function that they actually have. But you hear this in everybody's forecast just simply because we're throwing darts. And that's what it feels like.
I see a lot of daylight between what we're talking about in this program and what I'm hearing from Fed officials. Still a lot of daylight going into September 18th. We'll see what we get from Governor Waller a little bit later this morning. Equity futures on the S&P 500 pulling back once again near session lows. We're down by 0.7%. The jobs report is just around the corner. The next hour looks like this. Priya Misra of JP Morgan, Michael Zezas of Morgan Stanley, Bloomberg's Josh Wingrove, and we'll catch up with Aditya Bave of Bank of America. From New York City, this is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. The countdown is is on. Everything you need to get the edge.
Any chance that we are below 120, below 100, that's where you start to see some material volatility.
I certainly think if you do get a very weak print, say 125 or less, the Fed will likely cut by 50 basis points.
I don't necessarily think that we have to have a payroll report that is as strong potentially as 100K to have 50 basis points.
Take a deep breath. Things aren't falling apart out there, and a continued expansion is probably still the base case.
If we get that solid increase, they're on the way of achieving the result of a soft landing.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Kicking off September, selling stocks and buying bonds, and that trend continues. Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now. Your equity market on a three-day slide. It looks like this morning. It could become day 4. We're down by 0.6% on the S&P 500. On the NASDAQ, down by 1 full percentage point. Switch up the board and get to the bond market. The state of play, your scores. The 2-year, the 10-year, sliding for 4 consecutive sessions. This week alone, down 20 basis points at the front end and long end of the curve. The 2-year, 371. The 10-year, let's call it 370. Let's get to the guesses. The guesses look like this for 8:30 Eastern Time. 165,000 for payrolls, the median estimate in our survey. That's the headline. For unemployment, we're looking for that to drop back from 4.3 to 4.2, and immediately after, you'll see some revisions to some notes about whether we go 25 or 50 this month.
The time has come. That set off the trajectory, at least in the bond market. Stock market's just basically following the back-to-school trend of selling risk assets. But what we're seeing is the market pricing in rate cuts, and the question is just to where, given the fact that the Fed has already said the time has come. And that's where these estimates start to really make a difference. If they cut by 50 basis points, it's important to frame this. It doesn't just mean a one-time cut. It raises the point that maybe they will be cutting much more aggressively to an end point that is lower than what a lot of people thought.
That's why Austin Goolsby's comments last night were interesting. And then you have Stephen Stanley coming out from Santander saying he thinks it's pretty interesting that right after we get those numbers, we're going to hear from Waller and Williams. UBS's Paul Donovan this morning. In a well-run central bank, a single employment statistic would not change policy. Under Powell, data dependency mantra, the tone of this report could influence the size of the September rate cut. That's why it's going to be so important to hear what the Fed officials have to say after the data drop.
They say they're not data point dependent, yet this conversation sounds very data point dependent.
Well, part of that is because there's a question of how much it confirms what we saw from the July jobs number, right? This is the idea. Does it basically talk about payback, which you mentioned earlier, this idea that it's better than expected because it's taking into account the jobs that somehow were lost with weather-reported disruptions? Or is this really going to confirm some sort of downward trend that is faster than people previously thought? That's the reason why. Again, it's 50 basis points, and then what does that signal about where the Fed's headed?
Noise or signal. If you are just tuning in, welcome to the program. Cross-asset, equities down, bonds bid, the trend continues. Stocks lower by 0.6 on the S&P. Yields down by 3 basis points on a 10-year, 369.67. And the euro just about unchanged against the dollar at 111. Coming up this hour, we'll catch up with Priya Misra of JP Morgan on what she's calling a break-even payrolls print. Michael Zezas of Morgan Stanley as Donald Trump doubles down on tariffs, and Aditya Bave of Bank of America expecting an upside surprise at 8:30 Eastern Time. We begin with our top story, counting you down to U.S. payrolls. Bloomberg survey expecting 165,000 jobs added for August. Priya Misra of JP Morgan drawing a line, writing, if we get a 150 or higher print, the market can disregard the weak July report as a one-off. But another weak print, less than 100,000, will suggest the non-linear weakening in the labor market is now upon us. Priya joins us for more. Priya, good morning.
Morning.
It's good to see you. I want to pick up on a line that you've been pushing now for the best part of a month. We've had some people come on the program and say this market is pricing in things too aggressively at the Federal Reserve. You're going against that. Walk us through why.
So I think if I look at the total amount of rate cuts that are priced in, we're essentially, all we've done really is taken that endpoint from the end of 26, we've moved it to 25, which is a risk management approach. So I look at the totality of rate cuts. We're pricing that terminal rate after all the rate cuts at 2.9%. Whereas neutral rate, somewhere between 2.5 and 3, I would argue. So we're still pricing in very much a soft landing. I think what the market said is, well, the economy is actually slowing faster than it was 6 months ago. So the Fed, and we heard from Chair Powell, I think there was a subtle shift in the reaction function. They don't want any more cooling in the labor market. So that's the argument for a 50 now. Quickly get us to neutral. If the economy stays in a soft landing, that's essentially that 3% terminal, close to that level. That's where we get to over the next year. I think the question is the economy still okay? Are we still in a soft landing? That's why I'm nervous about today. You get another print, a weak print. I'm trying not to be too stressed out before 8:30. Sure. But, I think then we have to worry that this is a fast, and we saw it in the beige book, we saw it elsewhere. They can cut 50. But what will that 50 do? Then they really should be cutting series of 50, getting to accommodative territory. We're not priced for that.
So let's start thinking about the limits of this bond market rally. What I hear from you is that we don't need a recession or even much of a downturn to get 250 basis points of cuts. Is that fair?
It is, yes.
So you think there could be much more downside to yields from here than many people suppose, I guess?
I agree. I think if the economy is slowing down faster, and I'm not saying recession, I'm saying 0 to 100,000 on payrolls, that's slowing enough that the unemployment rate's going to keep going up. The Fed's cutting to accommodative territory. And they can't cut 200 at one go. So the lags, when you incorporate lags, transmission, I think it could take them a year or at least 6 months to get to accommodative territory. By then, the weakening continues because of the lag effect. So where's the 10-year in a slowdown? 2%. 2.5%, because where's the Fed cutting to? So I still think about, we're so stressed out about September 25-50. Think about the total amount of cuts. 250 is consistent with soft landing. They're going to cut 300, 400. I don't know about 500. I think that needs a financial crisis. So I don't want to get people's hopes up too much in terms of total amount of cut. I hope we're not getting there. But why can't they cut to 2% in a recession or a slowdown?
Let's just build on that. You're actually speaking to a sentiment that we're seeing from Citigroup as well. And Citigroup's global head of interest rate strategy came out today in an interview with Bloomberg and said the Fed does not take baby steps. They showed no hesitation on the way up in 2022, and they won't show any on the way down either. If today's jobs numbers disappoint, expect a series of 50 basis points, not only in September, but also in November and December too. Are you saying you agree with that you're sympathetic with that, and 150,000 is the line in the sand?
So I think initially I would completely agree. I think we're at 5.5. That's not the... I remember Chair Powell would say policy is in a good place. Well, policy is not in a good place. We're very restrictive. So can they cut a couple of 50s, 3 50s, as they're getting to neutral? Absolutely. Do they continue? Well, then we have to look at the economy. I don't know about getting to accommodative levels just yet. The economy seems to be in a soft landing. The totality of data, look at corporate fundamentals, default rate. It's not really suggesting that we're at the brink of a recession. We could get there. Recessions are always non-linear. I think this is what we're struggling with. Soft landing rate cuts are rare. It's happened once in 95. And so the market doesn't know what is a soft landing. And that was just 75 of total cuts. So I think, in my view, a few 50s, but this is where I hope they cut a few 50s to get us to neutral quickly. I don't know if they'll get there. Listen to the Fed speak. They're suggesting they have the luxury of time. At 8:30, we'll know whether they have the luxury of time. If things are slowing, they have to be fast.
You said something else. You said you don't want to get markets' hopes up, that they're going to cut 500 basis points or whatever, that they're going to cut to 0 again. And this raises the question of what the response will be to, say, a series of 50 basis point cuts in risk assets at a time when at one point you've got lower rates, meaning a good thing for risk assets, and the other, it speaks to something that's a little bit more protracted in terms of weakness in the market.
So I think the Fed will spin probably the first 50 or a couple of 50s as normalization. And so that's okay from a messaging standpoint, because the equity market's not going to say, what does the Fed know that we don't know? Why are they cutting 50? But this is where the data is going to come in. I'm more nervous about 8:30 in terms of, are we at the brink of the labor market deteriorating sharply? And if that continues, if, let's say, the economy continues to slow down, risk assets then are going to struggle. I think it's less about the 50, more about the economy where we are. Because, risk assets are perfectly priced for a soft landing. You increase that probability of a recession from 10% today to 25, 30%. That has to result in a repricing in risk assets. I don't know if 50 will do it, but if the data is weaker, I don't buy the argument that the Fed will cut 50 and so risk assets are okay. It takes a while. What's 150 going to do? Or even a couple of 50s. That's priced in. I think we have to get the economy stabilizing for some, maybe it's the election or some other global growth, which I'm not seeing really big signs of. We have to stay at this level for risk assets to take the 50 and say that's great news because we're normalizing faster away from this extremely restrictive policy.
Priya, how do you position in this world of nervousness you have?
I think high-quality spread products still make sense. I mean, you're locking in yields of 5.5%, 6%, and I think that's what explains why we're continuing to see flows into bond funds. You know, whether it's aggregate bond funds, corporate bond funds, you look at corporate fundamentals are strong. We are positioning more towards quality, away from some of the areas where we feel you're not getting paid up enough to take that risk, and I would say buy duration. I mean, this idea, I'd like to buy the 10-year above 4%, well, we may not be getting above 4%. Any rise in rates here is a buying opportunity. Correlations are back. We haven't had any yield in fixed income or any hedging property for the last 20 years. It's there. You're getting the yield and you're getting that diversification benefit.
Let's say Jay Pulaski were sitting on the other side of the table and he'd say, just take the big picture, zoom out, things are great, U.S. exceptionalism. I don't understand why one data point is going to really tip the scales in terms of perception about whether the economy is falling off a cliff or not. Why would you disagree? Why do you think that this actually is the moment of truth where you're going to actually see the direction of travel?
I think the speed of the deterioration has increased. The economy has been slowing now for the last year. In the last few months, I feel like you saw the beige book, the last payroll report, and you get one more like that, you're going to get more nervous. It comes down to valuations. We should be pricing in a 30% chance of a recession. I'm not saying 50, I'm not saying above 50. Given the totality of data, there should be a probability. It's that as that probability goes up, valuations change. And then we can take a step back and say, actually fundamentals are strong, or the Fed has quickly normalized. See, we're debating economic data and the reaction function. Then you might be able to take a step back and say, valuations now are pricing in enough of a chance of a recession and I can buy. I don't think risk assets are there right now in terms of pricing in that risk that things may be non-linearly, which is not normally a word you hear on TV, but I'm glad I can say it here, that it's often a non-linear. Every recession is non-linear. I don't know if we're at that point, but I think today will give us more of a sense.
Priya, it's good to see you. Thanks for explaining your views. Priya Misra there of JP Morgan. The last time we had a jobs report that week, the 2-year was trading in the 440s, briefly, but in the 440s. We're down to the 370s this morning on a 2-year yield. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The head of global affairs for X is leaving the company formerly known as Twitter. Nick Pickles was one of the few senior execs who made the transition to X after Musk's takeover. He said in a post that he made the decision to leave months ago. The company, though, is losing its global affairs head at a precarious time. There's heightened scrutiny around the world and a Brazilian ban of X. X didn't immediately respond to a request for comment. Kamala Harris raised $361 million in August. That's almost 3 times more than Trump. She's raised $615 million since President Biden announced that he would step aside on July 21st. The campaign said in a statement that more than 60% of donors in August were women. 1/5 were either registered Republicans or independents. Nearly 3 million people donated, including 1.3 making their first donation in the 2024 election cycle. All of that according to the campaign. And in the U.S. Open, American Jessica Puglia shook off a rough set to storm back and take the match against her opponent in the semifinal. She moves on to her first ever major final, which will face off against Aryna Sabalenka on Saturday for a chance at the trophy. In the men's tournament, 2 semifinal matches are ahead today, with #1 ranked Jannik Sinner versus England's Jack Draper. And this evening, an all-American semifinal, Taylor Fritz takes on Frances Tiafoe. And that's your brief, John.
Very cool. Danny, thank you. Up next on the program, doubling down on tariffs.
The key to this effort will be a pro-American trade policy that uses tariffs to encourage production here and bring trillions and trillions of dollars back home. And you know what? We deserve it.
That conversation up next. Live from New York this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
The jobs report just around the corner. The scores look like this. Equities a little softer, down negative, off by 0.6%. The rally in the bond market continues in the 360s on a 10-year. We're down about 3 basis points this morning. Under surveillance this morning, doubling down on tariffs.
I intend to reverse this model and once again turn America into the manufacturing superpower of the world. We can do that just with being intelligent. The key to this effort will be a pro-American trade policy that uses tariffs to encourage production here and bring trillions and trillions of dollars back home. And you know what? We deserve it.
So here's the latest. Donald Trump promising to use tariffs as an economic weapon in a potential second term. His remarks coming ahead of Tuesday's debate with Vice President Kamala Harris. Michael Zezas of Morgan Stanley writing the following. Tariffs could pressure economic growth, but possibly more so outside the U.S., potentially driving more dovish central bank policies overseas than at the Federal Reserve. Michael joins us for more. Michael, good morning.
Hey, good morning.
That's a thoughtful take on the situation for global central banks. Do you think some of those policies could be more damaging to countries abroad than maybe domestically?
Yeah, well, listen, if you think about the U.S.'s posture in terms of its trade relationships with the rest of the world, if it's tariffing more of its imports, then the more the pressure is going to be overseas. So this often comes up in the context of what does it mean for the dollar, right? And the Trump campaigns talked about the desire to have a weaker dollar, but some of these policies we think at least initially would manifest in a stronger dollar because it's putting more pressure on the rest of the world than the central bank dovishness you'd see overseas would outweigh what it would do to the U.S.
Most people talk about also in the context of what it means for U.S. consumers. But if you look at the rest of the world, who would win in that scenario?
Well, I think it's complicated to say that there are specific kind of winners and losers. What I'd say is if over the long term, if the U.S. is pursuing more protectionist policies in the aggregate, which it probably is regardless of who's president, it's just a matter of tactics. Republicans clearly want to lean more on tariffs. But what it does is create this long-term incentive towards nearshoring, reshoring, et cetera. And the places that are best set up for that, I think, are the ones that we know for the most part, right? Mexico, if you go into Asia, we're talking about Vietnam or maybe Turkey and MENA, because these are areas where you have to kind of recreate the labor supply and the labor cost elements that you have in China, but you can't do it in one place. You have to, if you're a multinational, you have to kind of do it in the aggregate in the multiple different places.
You have a hard job, especially at a time where people are saying it's basically a toss-up and nobody really knows what's going to happen, and people are coming to you to explain what's going to happen, and you say, I have no clue. But I am curious about whether it's getting easier in this one sense. The two parties are kind of coming to the same place. That increasingly it looks like the policies are very similar to one another. You just talked about how there are going to be protectionist policies no matter what. Is there a baseline of how much this gets accelerated regardless of whether it's Harris or Trump?
Yeah, I mean, so again, if we're talking about trade, the real difference is in the short term on whether or not you're using tariffs, right? And if that's true, then the real difference in 2025 is, are we pursuing trade protectionist policies that have tariffs or don't? The end state might be very much the same, but in the short term, the tactic of using tariffs just creates a lot more volatility and a lot more uncertainty around growth. And then to the extent that you've got a Republican pursuing those policies, maybe they're going to deliver something on the back end in 2026 that's helpful to the economy in terms of greater fiscal expansion, but the sequencing here is important because you might very well go through the tougher, more risky stuff up front.
And then you want to talk about corporate taxes. Now, we can have the tariff conversation. It's a bit easier because we don't have to talk about the makeup of Congress. When it comes to taxes, we do. Let's talk about how workable things are. Harris is saying take things from 21 to 28. Trump is saying take things from 21 down to 15, but with a lot of conditions.
Yeah.
I imagine you fielded a lot of calls yesterday from clients. What did you tell them about how workable the Trump plan is for a corporate tax cut?
I mean, it's fun. The workability of any of this is really a function more of politics than anything else, right? At the end of the day, all of these tax plans are going to have to pass through a budget reconciliation process that in some ways starts with party leadership deciding what number on the deficit expansion are they comfortable with, and then everything kind of fits inside of that. That's effectively what happened with the Tax Cuts and Jobs Act in the negotiation in 2017, where Senator Corker said we can do $1.5 trillion on the deficit, and then everything kind of fit in from there. So I think these proposals are important to talk about, and we have to pencil in assumptions for them, but how workable is 28% on cap gains as opposed to something higher? Well, that's really a function of what does the party decide in the aggregate they're willing to do on the deficit, and then therefore, what is it they feel like they need to pay for and what levers they have to pull from there.
There's a ton of proposals that are coming out of both sides, exempting on Social Security taxes, expanding child tax credit, which seems that both individuals want to do. What do you think is your base case actually gets done if we have a divided government?
Well, in a divided government, I think you can expect at least some of the kind of commonly supported provisions that are set to expire instead of the Tax Cuts and Jobs Act get extended. And then mostly kind of everything else goes to the wayside. So when we add up what we think are kind of commonly accepted provisions, it adds up to about $1 trillion of incremental deficit expansion over 10 years starting in 2026. That's where we think the bipartisan angle is. If Republicans sweep, we think that number can get as high as $1.6 trillion. If Democrats sweep because they'd be more willing to bring new revenue to the table on the tax side, that number could be like 500 to 700 billion instead. So really, I think we have to think more in terms of kind of the values and the principles each party is bringing to the table. The precision on the numbers is going to follow later after we get more details.
Okay, but I want to build at this, though, and this is what we were talking about with Tobias Marcus, too. I mean, we talk about the lack of clarity around some of these numbers that we get and the details that are yet to be worked out, and yet House after House has come out and said that Trump is going to increase the deficit more than Kamala Harris. We have a number of Republican strategists as well as people who could be his advisors who come on this show and get very angry. And they tell us that we're not accounting for growth that will come on the heels of some of these tax cuts, et cetera. What's the argument against that? Why is that not being included in any of this?
Well, okay, I think there's kind of there's a technical argument and then there's a more speculative argument. The technical argument is that the way the government's going to score any of these things typically is not going to account for incremental growth or dynamic scoring, as they like to call it. And so investors kind of not having certainty on that, particularly bond market investors, are really going to project or sort of discount to the present. What is the expected deficit projection that the government is telling them? That's going to factor into supply. And so the idea of sort of future economic growth kind of mitigating that deficit impact to like T plus 2, 3, 4, or 5 years later feels quite speculative, and it's not something that you can work with from an investment perspective.
Bank of America this morning said the most important NFP and most important debate of the year. That's what we're waiting for. The debate's important because we still don't know all of Kamala Harris's policy proposals. What are you most interested in trying to understand from her economic plans?
Yeah, I mean, I would love to hear more precision on both the tax and the spending side. I don't think you're going to get more of that from either candidate, though. And campaigns a lot of times are about putting your values out and expressing them in statements as opposed to specific policies, because that's going to be more persuasive to voters. So I'm obviously going to watch carefully what happens on the debate stage next week. I personally have low expectations for us learning more precisely what each candidate wants to do.
Have you developed much of a sector focus just yet, or is it still too early?
Well, I think there are some sectors that clearly sort of benefit or benefit less in either outcome. To the extent Democrats have more control, a lot of the sectors that benefit from the IRA, particularly clean tech, are going to be more secure because that spending is going to be more secure. If you have Republican sweep and therefore more of a skew towards extending more of those tax cuts, that skews more towards domestic industries, a little more towards small cap. I think it's one of the reasons that when it looked like Trump win probabilities were going a lot higher following the June debate, you started to see signs of life in small caps, and that's kind of come back as things have gone to more of a toss-up.
This is what Dan Greenhouse said yesterday on this program.
Yeah, essentially, that when you start to look underneath the hood, and this is what we heard also from Trump's potential advisor, that they're going to freeze some of that funding for the IRA, and that could end up really hurting particular areas, which is the reason why you're seeing some sort of shifting around the candidates.
To speak almost exclusively for the investor class, I think the way they view things at the moment is that Harris needs Congress to do some of the bad stuff, hike corporate taxes. Trump doesn't need Congress to do some of the bad stuff. He needs Congress to do some of the good stuff to offset the tariffs. So ultimately, I think the things as they stand are Harris needs a sweep, and that means that's bad for markets. And if Trump doesn't get a sweep, that's also bad for markets. Fair enough?
Sure. I mean, I think that right now, what I find most interesting is that regardless of whether that's good for markets or bad for markets, it's when it will be good for markets or bad for markets. And the fact that Michael Zezas is saying that essentially the sweeteners will come later because it will take longer, to me is indicative of, will the Trump trade look different this time around?
Mike, this was great. It's good to see you, sir. Complex stuff. Mike Zezas there of Morgan Stanley. Up next on this program, Cleveland Cliffs back in a conversation as speculation grows over the future of U.S. steel. That stock is up by 2.8%. The opening bell 2 hours away. The jobs report 60 minutes around the corner.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Three days of losses on the S&P 500. Here is day 4 for now. We're down by 0.6% on the S&P, down by a little more than 1 full percentage point on the Nasdaq. The Russell down by 0.5%. In the bond market, what a week already. Down about 20 basis points at the front end of the curve on both the 2-year and the 10-year for that matter. We're down another 3 this morning. The 10-year 369.86, the 2-year 372. Last time we were going into a payrolls report only a month ago, Elisa, that one had a 4 handle.
And we have a totally different perception now of the balance of risks, at least in terms of the reaction function for the Federal Reserve. People now talking about not just a 50 basis point rate cut this month, but a series of them, which we heard from Citigroup and then JP Morgan even, potentially talking about that. Question to me is, at what point does the Fed worry about spooking a market that already is a bit on edge, concerned about more significant weakness?
You can feel it. Think about how much weight we've put on the bad data this week compared to, say, the good data. And I use the word bad loosely. Let's talk about downside surprises on things like the ADP. ADP was the weakest number since 2021. Job openings the lowest since 2021. Not the kind of news you want to see if you are, say, looking for higher bond yields. Then you look at the ISM services print, pretty decent. Jobless claims, nothing to see here. But we haven't spent too much time talking about that in the last 24 hours, have we?
No.
That was the good stuff.
Well, the good stuff is sort of being ignored because it's A, backward-looking, and B, a lot of people are saying that the forward-looking indicators are weakening faster than people previously expected. We heard this from Austin Goolsbee overnight in a discussion with Market Watch. We've heard this from Mary Daly of the San Francisco Federal Reserve. And you get the sense, particularly in the beige book, there's certain areas that are just starting to roll over, and that never happens linearly, to use a fantastic word coined on the show today.
For foreign exchange, switch on the board. There's only one currency pair we'll all be looking at 8:30 Eastern time. It's dollar-yen. Yen strength for a 4th consecutive day. Dollar-yen down for 4 straight days. Back to about 143 right now on this currency pair. This was one to watch last time around, much more so given the moves we saw on August 5th, just a few days after that jobs report a month ago.
And the economic data is moving in the opposite direction in Japan. Let's just point out the fact that wages actually increased more than expected, even as they increased less than expected over the euro area, and people are talking about a flagging labor market expansion in the United States. At this point, can we be talking about diverging cycles that benefit the yen in an exact reversal of the consensus trade just a month ago? I mean, that's what Mark McCormick was talking about. How fast this has moved has been really notable, and you wonder how much the sort of corollary washout has actually already happened.
Dollar yen at 143. Under surveillance this morning, then our top story, the US payrolls report for August, just under an hour away. The median estimate in Bloomberg's survey calling for 165,000 jobs added. The unemployment rate expected to tick down to 4.2%. One of the most important events taking place this week was something Mike McKee mentioned earlier on. Mike McKee talked about 11 o'clock Eastern time on Friday morning being a key time. Why? Governor Wallace set to speak before the quiet period. How they frame whatever that jobs number is at 8:30 could go a long way to shaping expectations into the weekend and into September 18th.
If he uses the word moderate, there's your 25. If he talks about the importance of aggressive actions to get ahead of things, well, there you go. And basically, that's what you're going to be looking for. Look, it's really interesting to me that it's coming at that point. We also get the 8:45 speech from John Williams. Does this mean that they actually want to give a signal to markets, or are they just going to talk about, vague niceties?
I'd point out a few things. A lot of the language, some of the buzzwords in the Fed speeches over the last month, methodical, gradual. If you start to hear more of that again after the jobs report, whatever it is, methodical, gradual to me means 25. They open up the conversation to start saying things like, we're not restricted to only going 25, and we proved that in the other direction when we started the hiking cycle. Let's see what kind of language they use. I still stand by this, that there is some daylight between the conversations we're having on this program and the language they're using in the Fed speeches. They're still talking about gradual. They are not mentioning things like 125 or lower would mean we cut rates by 50 basis points. That is something of the market's own creation. There's a lot of daylight between these conversations and what they're saying, and maybe they close the gap in those speeches a little bit later, but for now, there is a gap.
There is a gap. It also has been moving very quickly, and we have to note that the data has been moving quickly, and the conversations that we're having with people are moving quickly. I can't think of a person who is talking about 150 basis points being cut in terms of the Fed funds rate over 3 meetings, just casually, as almost a consensus caller, an increasingly non-controversial one, and yet here we are. So it does feel like things are shifting pretty rapidly.
Look how low the bar is over at Citi. Great conversation with Andrew Honhorst earlier on this morning with Danny Berger and Manus Cranny. Andrew Honhorst has continued to say that all we need is 125 on payrolls, 4.3% on unemployment, which is where we were last month, and this Federal Reserve goes 50 on September 18th. That's a pretty low bar.
All you need to see is that there isn't payback from the July jobs report, that it wasn't necessarily a fluke or just weather, and suddenly people will start to count it as something meaningful. And that, I think, is the point that he's trying to get to.
Let's keep it on the labour market with this story. A union representing dock workers from Houston to Boston saying it will back a strike if their labour contract expires at midnight on September 30th. Talks with terminal operators and ocean carriers have stalled since June. Sticking points include higher wages and use of automation. Port of LA Executive Director Gene Soroka joining us on Tuesday, so we'll explore some of these issues. For the ports just across the nation, he's gone through it himself in the last few years, but this is another sticking point for unions in the labour market in this country.
And the timing could not be worse. It's coming not just ahead of the U.S. election, but also ahead of the time where you see these ports really start to have a buildup because of the holiday season. So this could not be worse for the current candidate, who is an incumbent, Kamala Harris. Sticking points, as you mentioned, Jonathan, are really everything: automation, healthcare, retirement benefits. This is what we heard from the West Coast. Some analysts believe the final agreement will exceed what they achieved on the West Coast, which is 32%. So basically, they're saying they're willing to go. Again, the timing is pretty brutal.
It's interesting to me to see this sort of last gasp with this timing, how much they're sort of relying on the political pressure to get this through, because we're not hearing a lot about strikes. Remember, say 2 or 3 years ago, when there were strikes everywhere as wages were increasing at a really rapid pace? This is the anomaly, not the norm right now, because the power has adjusted more significantly toward the employer and not the employee.
We've lost some labour leverage, that's for sure, but still seeing some of these issues on the fringe. Are they going to be things we see in the rearview mirror just a little bit more and maybe not on the horizon? I agree with you. Much more leverage maybe, say, a year ago than the kind of leverage that's out there at the moment.
I just wonder how much this is trying to leverage the political moment to say, actually, this is very good for us to get this done, and so why don't we do this right now and increase the pressure, and not necessarily because of the inflationary pressure that gives them that ability.
Reading the political tea leaves quite poorly, those operating in the steel industry. Cliff & Cliff CEO saying he's still in the market for US Steel. Lorenzo Concalves saying he's working on a plan to buy the firm if a deal with Japan's Nippon Steel falls through. President Biden expected to block the deal. Bloomberg's Josh Wingrove joins us now from Pittsburgh. Josh, walk us through how delicate, how finely balanced this conversation has become in the last couple of days after the US Steel CEO essentially threatened job cuts if this deal doesn't go through.
Yeah, good morning. Lorenzo doesn't really do delicate. So let's put the comments from Cleveland Cliffs aside for a moment. We just had everything sort of unload in the last week, including reports of a letter that went to the company from CFIUS sort of detailing objections, I suppose, and then the company's really sort of, emptied the chambers in terms of all the stuff that they were hoping to do or threaten, and that includes offering a majority American proxy board, which is a nod to the calls from Biden and others that the company be American-run. I suppose, how do you slice that? They're trying to thread some kind of needle. And, of course, the threat that, hey, nice headquarters you got there, nice plant you got there, be ashamed to lose that. They might pull up stakes if this deal falls through. We spoke with the head of the United Steelworkers yesterday. He's sort of just brushing it off, saying this is bluster, the company won't leave, these plants won't close. But there's a lot of moving parts here right now. There's also a question of when is this happening? We reported as soon as this week. Governor Shapiro of Pennsylvania said yesterday that there are essentially some kind of talks ongoing to protect those jobs, quote unquote, protect those jobs. And so now the question is, does that mean the governor is trying to walk Joe Biden back off the ledge? It's unclear. So right now the White House is super quiet. CFIUS is just this black box process. I'm here in Pittsburgh on the road with the vice president. As she does debate prep, she weighed in for the first time on Monday, hasn't touched it since. So a lot of things swirling right now, but Biden has been clear that he wants the company to be American-owned and American-run. And so the question is he bluffing?
But, Josh, he can't block it legally until that CFIUS review is done.
Yeah.
What is the timeline at all to wrap up that type of review?
White House officials have said they haven't transmitted the review to the White House. I think that's an important word. It doesn't necessarily mean that they don't know what the decision is, or, you know, that they're not expecting it coming around the corner soon. But they do need that to go there. We've also learned from CFIUS experts over the 9 months covering this that CFIUS itself, at least the panel, would probably be unlikely to block a deal like this with an ally country. But the sort of final panel includes members of Biden's cabinet, and ways that things can hit his desk is if there's a split decision. So it's not clear whether that'll be the case here. In other words, do they just sort of throw their hands up and be like, send it to the boss's desk? That could be it, as opposed to the whole process finding a problem here.
Well, based off past CFIUS reviews, what they usually do is they outline, it's a menu of potentially actions you could take. What actually are, you mentioned Japan's an ally, what actually are the national security concerns that your sources are telling you about this deal?
There's a few. Some have included the supply chain impact vis-a-vis China. Nippon Steel has some sort of downstream stuff in China. The question has been, well, will they have to divest those? That doesn't seem like a bigger sticking point. More broadly, they're just using the argument that steel is a sector that is itself a national security concern. This has been sort of a building thing, right? Trump's 232 tariff. We've sort of seen steel increasingly treated like some secret high-tech new thing that needs guardrails around it. And so I think that is where they're saying it, just this very simple nature of U.S. steel being foreign-owned hurts American security if you ever needed to, you know, rely on these countries to import the sort of raw steel that you would need from these blast furnaces, in particular, you know, roads, bridges, all that kind of thing. So it is a broader argument, steel as national security, rather than something that seems to be focusing in on, hey, what about those plants in China?
Josh, the more I read about this deal, the more fascinating it gets, because essentially it gives a test to the Kamala Harris campaign of what's worse. Is it the idea of international interference and the desire to have a more protectionist policy? Or is it the potential monopolistic tendencies in specific industries with, say, a Cleveland-Cliffs acquisition that she's seeking to prevent? I mean, which do you think is sort of the emphasis here?
I think for her right now and for the Biden administration in the last 9 months, it's union jobs, union votes. The steelworkers are against that. I don't think it's just that. And I think, you know, you talk about Cleveland-Cliffs earlier. Another thing is here, if they try to buy some of these assets, in particular the blast furnaces, which are the unionized part, that's going to create a market consolidation that we've seen the auto sector warn about. I mean, we've had Pennsylvania's lawmakers flipping out over this deal. If you start messing with the auto sector, well, I think we'll see Michigan's lawmakers flipping out in the opposite way. So there's no clear, real alternative here other than maybe U.S. Steel simply remains U.S. Steel. And that's where the CEO's warning comes in. Again, the union doesn't buy the warning, but the CEO's warning this week being like, these plants need investment. Not only is Nippon Steel offering $14.1 billion, they've offered $2.7 billion additionally on investments to keep those plants going. Without this deal, we don't have the money to do it. And so read the writing on the wall. Now, I should also note that the allegation from the union is that Nippon is willing to pay this premium simply because they've got excess capacity abroad. They're looking for a place to park it, and the union alleges the plan is sort of dump that here in the U.S. if they succeed in this deal. So it's tough. It's like you have the foreign offer, you have staying independent with the CEO warning they don't have the cash to keep things going the way they should, and you've got other domestic offers that create antitrust concerns that other industries like autos are going to flip out about.
Could be a big issue on the debate stage early next week. Josh, thank you, sir. Josh Wingrove there of Bloomberg on the latest in the steel industry. Let's get you an update on stories elsewhere. Let's take the opportunity to get you a Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Software billionaire Larry Ellison will take control of Paramount Global after a group led by his son, David, complete the purchase. The Oracle co-founder is backing his son's $8 billion proposal. A filing shows he'll take almost 78% of the Redstone family's interest in the film and TV company. Sources tell us Sherry Redstone will get $180 million in severance and benefits from the deal. That's on top of hundreds of millions more from the sale of her stock. Warren Buffett extended his sale of Bank of America shares into September, a total now of $7 billion since he started selling about 2 months ago. The latest round of transactions, Berkshire Hathaway liquidated $760 million of the stock this week. If Berkshire keeps selling, its stake in the bank could soon slide below 10%, the threshold where holding reports are no longer required. Buffett began building Berkshire's investment in Bank of America with a $5 billion deal in 2011. Boeing's Starliner is set to head home without its astronauts from the International Space Station as early as 6:04 p.m. Eastern today. In a statement, NASA said detailed checks concluded that the homecoming can commence pending weather and operational readiness. The spacecraft is returning to Earth after an orbit that began on June 6 and was only supposed to last 10 days before machinery problems were found. The astronauts are set to return months later on a February 2025 SpaceX flight. And that's your brief. John.
Danny, thank you. Lots to unpack here. One, I still can't believe there's 2 people stuck in space and we're just like, they're coming back in February. 2, can you imagine Daddy buying you an $8 billion company? Just like that? Can you imagine that?
Well, considering my personal experience where Daddy buys...
Amazing.
I can't even say it. I can't even say it.
Can you buy me AC Milan?
Yeah. Are you actually asking? Like, please, whoever, somebody out there, bless me with that. I mean, essentially.
Absolutely ridiculous.
Yes, this is the story.
Up next on the program, slow down fears mounting.
What looks like a soft landing, what looks like a very slow softening of the U.S. economy tends to accelerate.
The View from Bank of America, up next.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on